Okay, good morning, my dear students. Hope you guys are all doing good. Hope you guys are all perfectly fine. So, we are successfully into the fourth day of our CE final marathon. So, thanks for all the support. Thanks for all the participants till today. So, today we'll be proceeding with the day four of the marathon now. So, let us try to have a overview of what and all we have covered till now. So if you remember from the day one, we have covered various things like, so starting from day one, if we have a quick recap of what and all we have, what and all chapters we have covered till now. So we have started with introduction to audit. We have successfully completed introduction to audit. Then we are done with audit reporting. That also we are successfully completed. Then we have taken 500 series of the standards. Then we have taken 200 series of the standards. And after that, we have taken up quality control chapter. We have taken up professional ethics. Just in the previous session, we have completed the professional ethics. So basically, if you see, recently I have released a document called targeted chapter preparation. Like this, I have created one video where what kind of approach or what kind of strategy which you can follow in order to get through the examination. So in that targeted chapter preparation strategy, whatever content we have given, whatever chapters we have given it as first and foremost priority, that we are almost done, so that we have completed. So we will come back now. What we will do is we will go to the second priority and third priority sections. So first priority we have completed. These are the chapters, whatever chapters I have revised till now. These are all very important chapters from the examination perspective, very conceptual, both from MCQs and descriptive point of view. In both the cases, these chapters, whatever we have revised till now, these are going to be damn important. Now we are going to proceed further with second priority and third priority of the chapters for revision. So in that also, first what I will try to do today, my structure today, what I am planning is, so today I'm planning to complete audit strategy planning and program. Then I told you to at least go through risk assessment, internal control and materiality. This chapter is very important to have understanding of the questions. Overall chapter weightage might be less, but in order to understand the question, this chapter is such a basic chapter, risk assessment, internal control and materiality, which is having linkages with the multiple chapters. And especially when we are reading the questions, the knowledge of this chapter is very, very required. So that's why I told at least one minimum rating you have to give for this chapter. But I'm very worried that many people might leave this chapter from at least going through it once. So I will do one quick revision of this risk assessment, internal control and materiality. All the important concepts from the chapter risk assessment, internal control and materiality, I will do it. So, and after that, what I will do is I will pick up these things. SRS I will do, SAE I will do, standards on related services, and standards on assurance engagement also I will try to do it. Then once we are done with that, see what, sir, what about specialized areas? See, specialized areas, I have dedicated videos. I have uploaded full videos of specialized areas in my channel. So recently I have uploaded even demo lectures of the EOB lectures. So that demo itself, I have updated the entire chapter. I have uploaded the entire chapter of the specialized areas. So that specialized areas full video is already available on the YouTube. That way a recent video I have done on it, so that you watch it. So that you will watch it. So but we will do SRS and SAE we will do. Then after that, group audit and internal audit. If the time permits, we will try to cover both, or if the time does not permit, at least one we will try to do from this. Either group audit or internal audit, we'll try to do from this. And with that, today's session will come to an end. So day 4 will come to the end. See, initially I planned for marathon for four days only, right? Live marathon for 4 days I have planned, 9 to 12. So today is the 12th of August. But what I will do is, remaining chapters, as I'm aware, many students are asking for this audit of banks and audit of NBFCs. These I will upload a recording. This I will upload it on the YouTube. Yes, I am working on this audit of banks and audit of NBFCs. So from tomorrow there will not be any live. So today is the last live session of the marathon. But yes, I am giving a word from my side. I will definitely do the revision videos of audit of banks and audit of NBFCs, and I will upload it on my YouTube. Okay, from tomorrow will not have any live, but I will do. But I'm not ending the revision series with today. I will do. I will upload on my YouTube the videos relating to revision of audit of banks and NBFC. That 100% I will do it. Yes, I will definitely get it done. Okay, right. So having said that, let us now proceed further with our revision part. So what we will try to do now. So first we will try to pick it up. Audit strategy, planning and program. That chapter we will try to revise quickly. Very small chapter, very simple chapter. Very, what I will say is very routine chapter, point wise concepts all will be there. Here there will not be much concept for us to learn and understand. So conceptually very less discussion we will have. Most of the questions will be like advantages, benefits, what factors you have to consider, what things you have to pay attention. So these kind of things they mainly talk about it. So let us try to have a quick revision of this chapter, audit strategy, planning and program. And mainly in this chapter, this chapter is mainly going to talk about the planning process, overall planning process. So like the way for any activity which we want to do or which we are doing, which we are supposed to do, for all that activities, we do some sort of planning. For every activity, we do some amount of planning. So why we basically do the planning is because we want to have control over the process. If any activity we want to do, unless and until we have a proper plan, that activity might not be under our control. That activity might not be under our control. So if you want to have control over that activity, if you want to make the things happening on time, that too in a planned manner without any disturbances. So in order to make sure that there are no troubles in performing an activity, we spend a lot of time, we spend a significant amount of time on planning. Even audit is also not an exception. Whenever we are supposed to do an audit engagement of the client, for any client, if we are doing audit engagement, directly we will not jump and start doing the audit. Here also, even in the audit also, what we try to do is we try to spend some amount of time in planning that audit of the financial statements. Even in audit also, since it is also a normal activity like any other activity, even in audit also, if we want to do the audit in an effective manner, if we want to have the control over our entire audit process, if we want to make sure that our work is happening in a seamless manner, and if we want to make sure that we are doing the correct things like the way we do the planning for other activities, a significant amount of time we have to spend it even for planning of the audit of the financial statements also. And regarding the planning of audit of the financial statements, SA 300 gives us all the required guidance, what things you have to keep in mind, what factors you have to consider, how you have to do the planning of audit of financial statements. All that guidance has been given under SA 300. And in the SA 300, this standard says that when we say audit planning, when I say planning of audit of the financial statements, they say that from the audit perspective, whenever we are doing the planning of audit, it involves 3 phases or it involves 3 steps. So when it comes to audit planning, there are 3 phases or 3 steps for the purpose of involved in the entire process of the auditing. So what are that 3 steps or what are that 3 activities is? Number 1 is, first we will work on development of audit strategy. Number 2, we will work on development of audit plan. Then number 3, we will work on development of audit program. So planning of audit involves 3 phases. It involves development of audit strategy, which is the first and foremost step. On the basis of development of that audit strategy, we are going to develop an audit plan, and on the basis of that audit plan, we are going to work on something called audit program. Sir, what will be there in the audit strategy? Very simple. Audit strategy is the first and foremost step. So generally what we do is we try to decide on resources, how many resources we want to complete the audit, within how much time we want to complete the audit, what is the overall scope of the audit, what is the overall direction of the audit. So on a very broader level, we set one strategy for this audit. Like the way we will have the strategy for entire things. Like for example, if you have an objective of qualifying your CA final examination in the September 25 attempt or Jan 26 attempt, you will generally have that thing in mind. You will have one strategy. Okay, this subject I will concentrate more. This many hours I will subject on this. I will spend on this subject. In this subject I will get the aggregate marks. In the remaining 2 subjects I will try to qualify. So like that, you will have one strategy in place, right? Similarly, even in doing the audit also, we will have one strategy. We need to decide on how many resources we want for completing the audit. Do you want 10 resources, 15 resources, 20 resources? Within what time you are supposing to complete the audit? Are you trying to complete the audit in 10 days, 15 days, 20 days, 1 month? And what is your overall scope of the audit? What is your overall direction of the audit? So those things we will try to decide in a document called audit strategy. See, once we have established the strategy is just scratching the surface of the planning. The planning is not completed with the strategy. The planning has just begun with drafting of the strategy. Now what we will do is, on the basis of that strategy, we are going to work on developing an audit plan. Sir, what do you mean by development of this audit plan? So nothing but in the strategy we have decided on resources, how many resources we want, within what time we want to complete the audit. Say for example, in my strategy I have decided I want to complete the audit with 10 resources with 15 days of time. Now these are 10 resources. In these 15 days, which person should do which work, which person should handle which area. Each area requires how much amount of time. That allocation of time and resources should happen. the document in which I'm going to allocate that time and resources among the different tasks which are involved in the audit, that document I'm going to call it as audit plan. Like as I was saying, if I have 10 engagement team members and I have decided to do the audit within 15 days of time, now in audit I will have different areas, like I have risk assessment procedures, further audit procedures. In the further audit procedures also I have compliance. Compliance, I will check the internal controls. I need to check the internal controls in different areas: assets, liabilities, incomes, expenses. Then I need to perform further audit procedures. Now in the further audit procedures also I need to, substantive audit procedures, I need to perform substantive audit procedures in the area of assets, liabilities, incomes, expenses, and then I need to do some coordination. Then I have to arrive at the conclusion. Then finally I have to draft the opinion. So these many tasks are involved in the entire process of the audit. Now I need to allocate who will do this task and within how much time this task will be done. Say for example, risk assessment procedures I have allocated to engagement partner, and the time which I am allocating him for completing the risk assessment procedures is 2 days, for example. Compliance procedures in the area of assets, I am allocating this work to Mr. A, who is an audit manager, and I am giving him 3 days of time. So like that, each area who will handle it and within what time they are supposed to complete, when they have to coordinate with each other, when they have to arrive at the conclusion, when they have to draft the opinion, when they have to sign it. So all this task, whatever are involved in the entire process of the audit, who will do it and within what time they will do it, that I will try to document in a document, that I will try to keep it in a document, that I call it as, that document I call it as audit plan. So then we have something called audit program. Sir, what is this audit program? Now I will say audit program is a much more detailed version of the audit plan. Audit program is a much more detailed version of the audit plan, which is going to contain verification procedures. It is going to contain instructions which are required to be followed by the members of the engagement team in each and every area. Like for example, in the area of purchases, I have allocated a substantive audit procedures to one of my article assistant, Mr. A. Okay, now this person, Mr. A, in this area of purchases, while performing substantive audit procedures, what and all instructions he will require to follow, that I will give it in a document. Like I will say, you are required to take 10% of the sample. B, you have to do inspection. You have to verify internal controls. You have to decide whether you can rely on the controls or not. You have to coordinate with the person verifying the trade payables. So like that, what instructions is required to follow, what verification procedures he needs to apply in that specific area. The detailed verification procedures along with instructions will be contained in a document. That document I am going to call it as audit program. So if you have done audit strategy, if you have built the audit plan, if you have built the audit program, then your planning process will come to an end. And if you want your audit to be effective, and this planning process has to be compulsorily taken care of. Okay. And as I've told, first thing what I will try to do is, first I will try to establish the audit strategy. Now my question is, will I establish the audit strategy after performing risk assessment procedures, or I will perform risk assessment procedures after building audit strategy? When I will perform risk assessment procedures, will I perform risk assessment procedures before establishing audit strategy, or will I perform risk assessment procedures after establishing audit strategy? The answer is, you will try to perform risk assessment procedures before performing audit, before building the audit strategy. Why? Because as I have told, in the audit strategy, we are required to work on timing and resources required for completing the audit. If we want to decide how much time we want for completing the audit, how many resources we want to complete in the audit, how many resources we want for completing the audit, that decision I can take it, not just whatever comes to my mind. I have to take that decision on the basis of size of the entity, nature of the business, their operations, what is the volume of the transactions, what is their to which industry they will belong, what are the requirements of applicable financial reporting framework, what laws and regulations are applicable for them. So like this, unless and until I know all these activities, I can't get the required information to decide on the audit strategy. So first, auditor will perform risk assessment procedures. And also, if you remember, at the beginning somewhere I have told that you will perform something called preliminary engagement activities. Yes, even you will perform the preliminary engagement activities like drafting the engagement letter, communicating with the previous auditor, determining whether it is suitable to accept or continue the client relationship. So that preliminary engagement activities also I will perform. So I will complete my risk assessment procedures. I will complete my preliminary engagement activities. After that, I will start working on development of audit strategy. Directly, I will not jump into the development of audit strategy after performing risk assessment procedures and after doing the preliminary engagement activities. Depending on the outcome, depending on the information, whatever I get from the risk assessment procedures, and depending on the outcome, whatever I get for this preliminary engagement activities, I am going to work on my audit strategy. Then audit plan, then audit program. So that's all, guys. This is what the concept we have in this chapter. Apart from this, we don't have much concept to discuss. Now what will be there in this chapter is just a list of questions which is talking about when you are developing audit strategy, what factors you will consider, whenever you are developing audit plan, what things will be included, advantages of planning, advantages of strategy, what things you have to keep in mind while developing audit program. So like that, a series of point wise questions are going to be there, which we will try to complete as quickly as we can. Okay, right. Come on. Okay, so first one, as I've told, first and foremost activity is establishing the audit strategy. And if you see here, we have one particular question, one particular concept, very important. Multiple times they have asked it in the examination. So very, very important. So the first aspect is what factors you are required to consider while establishing the overall audit strategy. So as I have told, in the audit strategy, we are going to decide on the time and resources. But as I have told, we will not just like that arrive at whatever things come to our mind. So if we are deciding certain time for completing the audit, if we are deciding these many number of resources are required for completing the audit, that decision should be an informed decision, that in arriving at that conclusion, various factors we have to consider. So what and all are the factors which you have to consider? So this particular standard, this particular essay 300 says you need to broadly consider 5 factors. Number 1, first thing, you need to consider characteristics of the audit. Number 2, we need to understand, we need to keep in mind reporting objectives. Number 3, we need to understand, we need to consider various other factors which I might feel important in my professional judgment. And even as I've told, I will perform preliminary engagement activities. I will consider the results of that preliminary engagement activities, and even I will pay attention to nature, timing, and extent of the resources. Even I will pay attention to nature, timing, and extent of the resources which I have. So while establishing overall audit strategy, I will consider 5 factors. What are they? Repeat everyone. Characteristics of the engagement, reporting objectives, team's efforts, considering the results of preliminary engagement activities, and nature, timing, and extent of resources. And in this question, you will be able to find, in this concept, you will be able to find examples of what will be included in the characteristics of engagement, examples of what will be, you will consider in the reporting objectives, what are that matters which are significant in the auditor's professional judgment, what information regarding preliminary engagement activities you will consider. So like that, we have a few examples. Like if we quickly go through here, like as I was saying, if you are establishing audit strategy, you need to consider characteristics of your client. Sir, what characteristics I have to pay attention? Like you have to pay attention, what is your client's applicable financial reporting framework? And also you need to understand, is industry to which your client belongs. According to that industry, any specific requirements are there. You need to understand what is your coverage, how many number of locations you have to do the audit, how many locations you have to do the audit, if there are branches, separate branch auditors are there or not there. And even relationship between parent and components. If you are conducting audit of consolidated financial statements, you need to even understand the relationship between the subsidiary, holding, associates, etc. And even the extent to which the components are audited by others. Once again, the components have they been audited by other auditors? And is there any requirement to make use of service organization? Is your client making use of services of the service organization? And if previous year's audit evidence is available, if yes, can you use it? And what is the effect of information technology? How far your client is making use of information technology? And even availability of client's data, whether client's data is completely available. If available, what volume of the data is available? Able to understand? So like this, these are the examples of the characteristics of audit which you need to keep in mind while establishing audit strategy. Then we have reporting objectives. Reporting objectives basically means, is there any timeline for reporting? Is there any timetable? If the management has set one timetable for reporting, are they having any deadline for disclosing their financial results to the public? So like that, we need to understand reporting objectives, and the examples which will come here in an area of reporting objectives is, like as I've told, timetable for reporting. Is the entity is following any timetable for reporting? Organization of meetings, when management have planned for their board of directors meetings. And also, is there any what type of reports you are required to give, and within what time you are required to give that reports. And you have to continuously communicate regarding the status of the work, and even communicate with the auditors of the components. As I've told, if there are other auditors, try to communicate with them. And nature, timing, and communication. What nature of communications are required? What is the timing? What is the expected time within which such communications are required, or any other expected communication? So basically, you are required to consider all that reporting objectives. And then they say team's efforts, not just the above. If you consider anything other, any other factor which you feel in your professional judgment as significant, consider that factors also. Then comes the fourth aspect. You need to consider results of preliminary engagement activities. Like as I was saying, you would have performed the preliminary engagement activities, like you would have drafted engagement letter, you might have communicated with the previous auditor, and also you would have determined that factors regarding acceptance and continuation of client relationship. So all this information, all these activities will fall under preliminary engagement activities. From that preliminary engagement activities, you have got some information, use that. And also, if you have performed any other engagements for the client, in the past, Even you can use the knowledge gained from that other engagements also. Like what kind of knowledge, sir? What kind of information regarding preliminary engagement activities, or what kind of knowledge gained from other engagements I can use? Here also they have given example like determination of materiality, identification of areas where there is a high risk of material misstatement. Should also pay attention impact of the what is the impact of that assessed risk of material misstatement, and also is there any need for maintaining professional skepticism? 100% yes, there will always be need for maintaining professional skepticism, but in some clients I need to maintain high level of professional skepticism. In some cases I need to maintain low level of professional skepticism, that I will decide. And also results of previous audits, firm's personnel performing other services. Is your firm performing any other services for the client? Use that information. And whether your client is having strong internal control, and what is the volume of the transaction, importance to internal control, how much importance your client is giving to internal control, what business developments have taken place which are affecting the entity, has the industry undergone any significant developments, are there any changes in the applicable financial reporting framework. So if you perform preliminary engagement activities, or if you have performed any other engagement for the client, you will get to know this information. This also you can use it for establishing audit strategy. And one more last factor which you have to pay attention: nature, timing and extent of the resources. So before you establish the audit strategy, you should also select your engagement team properly, and whether you have to properly assign the audit work or not, and also engagement budgeting also you have to do. So keeping these factors in mind, you will decide on the resources. Clear? Next. Then they say, sir, okay, I will establish the overall audit strategy, but what is the benefit of establishing the overall audit strategy? They will say 3 benefits. The standard has told there are 3 benefits for establishing overall audit strategy. Number 1, you can make better decisions regarding deployment of the capital qualitative resources. Which resources are required to be deployed? Like, do you need experts? Do you need highly experienced team members or low experienced team members? If you need experienced team members, you will go and allocate that to the high risky areas. If you have less experienced team members, that you will go and allocate it to the low risky areas. So by establishing audit strategy, you can take better decision regarding employment of the qualitative resources. Then allocation of quantity, you can also take better decision on quantity of the resources. How many number of resources you want for each area? For inventory verification, how many people I want? For internal control verification, how many people I want? So you can take better decisions regarding quantity of the resources. And also you can take better decisions regarding timing, when resources are required to be deployed. So 3 questions it will answer. By establishing audit strategy, you will get benefited in 3 ways. First one, which resources are required to be deployed, that is qualitative or experienced or less experienced. Number 2, how many number of resources are required to be deployed. Third one, timing, when the resources are required to be deployed. And not just that, by having an overall audit strategy, you can betterly manage your resources also. Better management of the resources is also going to happen. Then what are the benefits or advantages of planning? So if you do the planning, see, planning is a process. See, I told that we will establish the audit strategy, we will develop the audit plan, we will develop the audit program. No, so the time which we are spending, or the process of this development of audit strategy, audit plan and audit program, this process I call it as planning. Audit plan is different, planning is different. Audit plan is a document which contains the allocation of the work and resources, whereas planning is the entire process. At the beginning of the audit, we all will sit together and establish this audit strategy, planning and program. No, that process I call it as audit planning. Sir, why it is important to do the planning? Why can't we directly jump into the audit and start doing our procedures? Why? Because if you do the planning, you will get benefited. How you will get benefited? So common sense points, you will get to know which areas to pay attention to, which areas require more attention, which areas require less attention. And if any problems arises, in a timely manner, you can resolve them. You can properly organize and manage your engagement team. You can betterly select your engagement team members. You can direct and supervise your engagement team, and even it will promote the coordination. If you do the planning, that will result in better coordination among the engagement team members. Right? Sir, what are the factors which affect nature and extent of planning? What do you mean by nature and extent of planning is, will I spend more time on planning, or will I spend less time on planning? That depends on what factors. So the factors which are affecting nature and extent of planning means, am I going to spend significant amount of time in planning, or will I spend less amount of time in planning? That depends on what factors? Simply 3 factors. It depends on size and complexity of the audit. Audit in the sense client. If the client is very complex, if the client's business is very complex, there I need to spend more time on planning. If the client is very simple, if the client's business is very simple, like it is just a trading entity, wholesale entity, there the business is very easy to understand, I need not spend more amount of time on planning. It also depends on my and my engagement team's past experience and expertise. If all my engagement team members are having enough of expertise, this kind of company, this kind of industry, we have done multiple times audit, no need to do, no need to spend so much amount of planning. You can spend less amount of planning. It also depends on changes in the circumstances. If the circumstances are frequently changing when compared with the last year to this year, then also we need to spend some significant amount of time in planning. So these are the factors which affect nature and extent of the planning. Now, what should be the contents of audit plan? As I have told, on the basis of audit strategy, you will develop a audit plan. No, in that audit plan, what contents will be there? What you will include in the audit plan? Like what audit procedures we will do, who will perform the audit procedures, who will review the work, when we have to coordinate, when we have to form the conclusion. So like that, all such contents will be there. So if you start reading it here, so it contains nature, timing and extent of risk assessment procedures. It will contain nature, timing and extent of further audit procedures. It will also contain details of other planned audit procedures. And between audit plan and audit strategy, which one is more detailed? Between audit strategy and audit plan, which one is a more detailed document? Audit plan is a more detailed version than audit strategy. So audit plan, in the audit strategy, we just decide on the time and resources and overall scope and direction. But in the audit plan, we actually allocate the work among the different resources. So generally, audit plan is much more detailed than the audit strategy comparatively. And both this audit strategy and audit plan are closely related with each other. Both this audit strategy and audit plan, both are closely related with each other. If you are making a change in one, other thing is also automatically required to be changed. So if you make any, these are not two separate activities. Audit strategy and audit plan are closely interrelated processes. If you make change in audit strategy, that requires change in audit plan. If you make change in audit plan, that requires a change in the audit strategy. Both are closely interrelated with each other. So that's what they try to explain here. Relationship between audit strategy and audit plan. Both are closely related. A change in one will resultantly lead to the change in the other. Next. One more thing they say here, planning is not just one-time activity, it is a continuous process or a iterative process. Iterative process means a repetitive process. It is not just some one-time activity. It is not like at the beginning of the audit, we have done the planning and we have ignored it. It is not like that. Planning is something which is a continuous activity. It happens on a continuous basis. Throughout the audit, it will happen. And in fact, what they will say here is the process of planning will start from the completion of the previous audit engagement and it will continue till the completion of the current audit engagement. Sir, what does that mean? Throughout the audit, will I be doing only planning? No, that's not what I meant there. What do I mean by planning is a continuous process? At the beginning, at the starting phase of the audit, we plan the audit. We will have an audit strategy, planning and program in place. But during the course of the audit, if required, or we should be alert, or we should remain alert to the information which might require us to make changes to your audit strategy and plan. If at all you come across any circumstances which require you to make changes to your audit strategy, planning and program, you should be ready to update it. So that is what the meaning of planning being a continuous process. So planning is not just a discrete phase of an audit, but rather it is a continuous and iterative process. And once again, they say a few more things here. When you are planning the financial statements, when you are planning the audit of the financial statements, what matters you are required to consider? Like I need to analyze what analytical procedures I want to perform, and also I need to keep in mind understanding of the legal and regulatory framework while doing the planning, and also I need to determine my materiality. I need to determine is there any requirement of experts to be involved, and even performance of other risk assessment procedures. I would have performed risk assessment procedures, that information also I have to use. That's why I told first you need to perform risk assessment procedures, then only go for the planning of the audit of the financial statements. Next. Sir, you are telling planning, just now as I have told, during the course of the audit, we might be required to make changes to our planning decisions, no? So generally, at the beginning of the audit, we decide the plan. But during the course of the audit, we might be required to make changes to our planning decisions. What do you mean by making changes to the planning decisions? Changing my audit strategy, changing my audit plan, changing my audit program. Sir, because of what circumstances what are those circumstances which might lead to changes in the planning decisions? So like as you could see here, there could be unexpected events. Sometimes unexpected events will happen which might be required to make my change my audit plan or strategy or program, or there might be change in conditions. Whatever conditions that are prevailing at the time of planning, the same conditions might not be prevailing at the time when I have started doing the audit. Or even when you obtain during the process of the audit, when you have actually started performing audit procedures, sometimes from that procedures you get some extra evidence. That evidence also might necessitate you to go and make changes to your planning decisions. So these are the factors because of which planning decisions might be changed. What are they? Because of unexpected events, because of change in conditions, or because of audit evidence which you have gathered. Next. Sir, who is responsible for preparation of audit strategy and audit plan? So tell me, who is responsible for building that audit strategy and audit plan? So I will say here, the ultimate responsibility for development of audit strategy and audit plan is with the auditor, generally engagement partner. So engagement partner is ultimately responsible for development of audit strategy and audit plan. There is no denial of that. But do you think engagement partner single-handedly, without involving anybody, will he build the audit strategy and audit plan? It's not like that. So yes, what I have told is correct only. So audit strategy, audit plan is the responsibility of the auditor. Engagement partner shall do it, but it doesn't mean he will do it single-handedly. The process of development of audit, in the process of development of audit strategy and audit plan, engagement partner is going to involve different kind of people. Engagement partner is going to involve different kind of people. Sir, who and all will be involved, sir, in the development of audit strategy and audit plan? Do you think engagement team will be involved? 100% yes. So as an engagement partner, while I am establishing audit strategy and audit plan, it is always necessary for me to involve my key engagement team members. Why? Because if you involve the engagement team members, you will get to know about their experience, expertise, and they will also know better understanding about the audit, so that you can allocate the work in a better manner and you can improve the overall quality of the audit. So that's why in the process of building of the audit strategy and audit plan, there is no doubt at all, I will involve my engagement team. 100% I will do it, because it will improve my effectiveness of audit. Now the question comes, do you think while establishing the audit strategy and audit plan, is there any requirement for the engagement partner to even involve clients, management and staff also? So as a part of that drafting of, as a part of development of audit strategy and plan, is there any requirement for the engagement partner to even involve the client's management and client's staff also? Yes, even you have to involve the client's management and staff. Why? Because if you want to do the audit in a seamless manner, you will need the cooperation of the management and those charged with governance. Without their cooperation, you will not be able to do your audit will not happen in a smooth manner. So that's why auditor must also include the client's management and staff. But you have to be very careful here. You should not, care should be taken that you are not disclosing the detailed audit plan and strategy with them. Why? Because if you discuss with them the detailed audit strategy and audit plan, what you are going to do becomes highly predictable, and the management will take all the precautions to make sure that no misstatement is coming to your notice. So that's why you should involve the management and clients staff. Yes, agreed, but only involve them to the extent their involvement is necessary. Don't discuss a detailed audit plan and strategy with them. That will make your audit completely ineffective. So that is what this question is about. Then we have next aspect, sir, whatever audit strategy we have developed, whatever audit plan we have developed, are we required to document it? Yes. So whatever audit strategy you have developed, that you have to document. Whatever audit plan that you have developed, that you have to document. If you have made any changes to the audit strategy and audit plan during the course of the audit, the changes to the audit strategy and plan, or even if I can put it in that way, revised audit plan and audit strategy, and not just that, because of what reasons you made that changes, that also should be documented. Everything should form part of documentation. Okay, right. So audit strategy, audit plan, and changes to the audit strategy and audit plan, and even reasons why you have made the changes to the audit strategy and audit plan, all these things must be included in my audit documentation. Sir, why the documentation of these things is also required? Why? Because at the planning stage, we are going to take very important decisions. So very significant decisions, like as you could see, we are making very key decisions, important decisions will be arrived at the planning stage. So that's why even documentation of audit strategy, planning and program also required. And even it will also serve as a record of nature, timing and extent of risk assessment procedures. As I have told, at the time after performing risk assessment procedures only we do the planning, no? So that's why if you document the plan, that will betterly document even outcome of the risk assessment procedures also. And also if you have made any changes in the audit strategy and plan, and even that changes, along with that changes, even reasons why the changes are made, that also must be included in my documentation. So this is what regarding audit strategy and plan. So this is one aspect. We are done with the audit strategy and plan. But as I have told, planning process involves 3 steps, not just audit strategy and audit plan. It also involves something called audit program, right? So let us try to understand what is meaning of audit program, and they say a few aspects regarding audit program, that also will try to understand it. So what is the meaning of audit program? Why it will be prepared? So it will be prepared to allocate the work to the team members. But what exactly is the audit, what exactly will be there in the audit program is, it will contain audit objectives. For each item of the financial statement, what is the objective? What is your outcome from, what should be your outcome from that audit procedures? And for each area and have sufficient detail to serve as a set of instructions to the assistants. As I have told, audit program is such a document which will contain instructions, which will contain verification procedures to be applied to the given area along with the objectives which you are required to achieve. Now, how you have to formulate when you are formulating audit program, what matters you have to consider. See, if I am building an audit program, if I am drafting an audit program, so in the audit program, as I have told, I will include instructions. I will include verification procedures. But how you will arrive at that conclusion? What instructions your team member should follow? What verification methods your team should follow? That how I will arrive at my conclusion? That I will arrive at that conclusion by considering various matters. So whenever you are developing, whenever you are formulating an audit program, there are various matters which you are required to consider, like what is the nature of business in which the organization is engaged. You have to pay attention. What is the client's business? Are they manufacturing? Are they service sector? If they are manufacturing, to which industry they belong? If they are service sector, to which industry they belong? So their laws and regulations and all that things we have to understand it. So you need to draft audit program after considering the nature of the business in which the organization is engaged. And also your audit program must be in line with the audit plan. So say for example, if in my audit plan I have allocated for purchases 2 days of time. Now I should also draft my audit program for purchases in such a manner that I should include those instructions and verification procedures in my audit program which can be completed within 2 days. It should not be like in my audit plan I am including 2 days, but in the audit program I am saying I will do verification, but in the audit program I am including such verification procedures which will easily take 5 days. You tell me, if that is the case, is there any purpose of doing the planning? No. So that's why your audit strategy should always be, your audit program should always be in line with overall plan. And also in your audit program, you should give instructions about internal control systems, what aspects they have to verify regarding internal control, and what accounting procedures you are required to verify. That instructions is also required to be given. So in the audit program, you have to include whether there is a existence of system of internal controls to prevent the errors, whether it is there or not. You add the instruction to check it, and even whether accounts are properly authorized or not, and also whether you can place the reliance on internal controls or not, and even review and so this is one more step they will say. So when you are verifying internal control system, it generally has 3 features. So whenever you are verifying internal control system, it should have 3 features. Number 1, first we have to do review and preliminary evaluation. That means one basic study we have to do first. Then after that we have to test the compliance. Basically we have to first understand the controls, then we have to test whether they are operating effectively or not. Finally we have to analyze whether the controls are working effectively or not. So when you are drafting audit program, include instructions regarding this internal controls and accounting procedures also. And even you have to pay attention to the size of the organization and structure of its management. You have to draft your instructions after considering what is the size of the organization, what is the management's structure, and also information as regards organization of the business, how the business is getting organized, how the business is getting run, that also you need to consider. And then information as regards, accounting and management policies. So whenever you are drafting an audit program, after considering all these matters, you have to draft the audit program. You have to formulate the audit program. So tell me, what are the matters which you have to consider while formulating the audit program? Number 1, nature of the business in which organization is engaged, overall plan, system of internal control and accounting procedure, size of the organization and structure of its management, information as regards the organization of business, and finally accounting and management policies. So consider all these matters into consideration and then formulate the audit program accordingly. Able to understand? Clear and comfortable, everybody? Next. See, like the way we are making changes to the audit strategy and plan, like in the previous part of the chapter we have seen. Initially we establish audit strategy and audit plan, but if required during the course of the audit, we make changes to our audit strategy and audit plan, no? Similarly, once we have drafted our audit program also, during the course of the audit, if required, even we can make changes to our audit program also. Sir, when we will make changes? In what circumstances we generally make changes to our audit program? So they say that if the audit procedures were designed for certain volume of turnover, but subsequently volume has increased. Like say for example, as we all are aware, the auditors generally will not wait till the completion of the year to do the audit. In case of big entities, even during the year only we start doing the audit. So when we have started doing the audit before the closure of the financial year, we thought that okay, revenue of the company will be 100 crores only, and keeping that the company is a mid-sized company, I have drafted my audit program. But once the year got closed, I came to know that the actual revenue was not just 100 crores, the actual revenue was 500 crores, more than whatever I have expected. Now you have drafted your audit program that you're that assuming that the turnover of the company will be 100 crores, but now you got to know what is the actual turnover. Don't you think you are required to make changes to your audit program? 100% yes, we will be required to make the changes to the audit program now. Next, one more case where internal controls are less effective. Initially, you thought that on a basic understanding of internal control, you felt that internal controls are effective and accordingly you have drafted your audit program. But later, when you actually started performing procedures, you realized that internal controls are not that effective as they look. So now you thought of it. Now you have to revise your audit program. So because you thought internal controls are effective and you might have drafted less instructions for audit program, but now you realize that internal controls are actually not that effective. You have to include more instructions, revise your audit program. And whether in case of extraordinary increase in the book debts or stock value. So then when you have done the planning, now when compared with it now, like the way turnover or volume has changed. Similarly, if there is a significant increase in the book debts or stock value, that too when compared with the previous year, then also you have to make changes to your audit program. And also whenever you have got a suspicion, in case if any suspicion or information you got that assets might have been misappropriated, initially you don't know that, initially you did not felt that need, you felt that there is no chance of misappropriation, but later you realized in this client's organization there are more chances for misappropriation of assets. Now also you have to make changes to your audit program. So basically when the circumstances change, when you get more evidence during the course of the audit, then it becomes necessary for us to go and alter our audit program. Next, so we have one more last aspect from this chapter, so where they will say about how what are the audit execution. So till now we have seen the planning. Now they talk about overall execution, how audit from beginning to ending is going to happen. So like as I have told, first phase will be planning. We spend significant amount of planning just till now. That is what we have seen in the chapter. So we draft the audit strategy, we draft the audit plan, we draft the audit program. So first we do the planning. Once we are done with the planning, then we do risk and control evaluation, basically risk assessment procedures, understanding the entity, understanding internal control, understanding environment, identifying the risk of material, identifying the risk of material misstatement, assessing that risk of material misstatement. So that risk and control evaluation we will do. So once that risk and control evaluation is over, basically they are referring to risk assessment procedures. So once that risk and control evaluation is over, then we do the actual testing. Here they talk about actual testing of operating effectiveness of internal controls. Then we do compliance procedures. And then after that, we do the substantive audit procedures also. And from that, we are going to get the evidence. On the basis of that evidence, we will form the conclusion. We will arrive at the opinion. And that opinion, we are going to express in the form of a written document. That document, we call it as a report. This entire process, we call it as reporting. So whatever we know from the beginning, whatever we know, the same thing only they are trying to say it here. But they gave the side headings, that's all. So this is what the entire execution of the audit, this is what will happen in the entire execution phase of the audit. So we spend time on planning, we do the risk and control evaluation, then we do the actual testing, finally we do the reporting. What are our observations are there that we'll try to report it in the form of a written document, which we generally are going to call it as audit report. Understood everyone? So this is what regarding audit strategy, planning and program. So this is why I have included in a second category prioritization is small chapter. They might not ask the question every attempt. They might not ask question. In few attempts they have missed, but in majority of the cases they ask the question from this chapter, audit strategy, planning and program. But in case if they asked it, very few pages, hardly, even if you see in the material also some 6 pages is only there. Small content, limited content, easy to prepare also. And if at all a question comes from this chapter, easily 4 to 5 marks you can fetch it. Okay, so that's why these kind of chapters which generally students will ignore a lot, but this is where you are going to fetch the marks if things goes well. Okay, right. So with this we have completed audit strategy, planning and program chapter. Audit planning and execution, they say the title, so that we have completed. So now as I have told, risk assessment and internal control. So even though I have put it in the third priority, why I am doing it, I have already told you. Why? Because the understanding of the chapter is very important for you to read the questions and interpret the questions. Even if you don't remember the content of the chapter, even if you ignore this chapter from the memorization point of view, but understanding the terminology of this chapter is very important. Why? Because if you don't understand the terminology of this chapter, you are not going to understand the exam questions. So that's why it is highly important for us to do, for us to have a basic conceptual understanding of risk assessment, internal control and materiality. So I will take a small amount of time and I will try to cover the important concepts from this risk assessment and internal control. Here I will get little bit choosy. So whatever is important for MCQs, whatever is having linkages with the subsequent chapters, so that part of this risk assessment, internal control and materiality chapter, that we will try to have a thorough and a quick revision now. Okay. So once we are done with this risk assessment, internal control, materiality overview of the revision, once we are done, then we go with the group audit, then we go with the internal audit, then we go with SAE and SRE. First we will do SAE and SRS. We will complete very small chapters after completion of risk assessment, internal control. Then we will look into group audit and internal audit. Okay, right. Right. So let us try to have a quick overview of the chapter risk assessment, internal control and materiality. So three aspects are involved in this entire chapter. Right. See, people are commenting on the chat box. See, I have already told you at the beginning of the video itself, I will do bank audit, NBFC audit, I will get it done. Group audit we will do in this class only. So please watch the video from the beginning. You will get to know what I will be covering, what I will not be covering. So yeah, please. So risk assessment, internal control and materiality. So this chapter we will try to revise it in a quick manner. So risk assessment, internal control and materiality. So there are three aspects, as you could see in the title of the chapter itself. We have three aspects of this chapter, three concepts we are required to discuss. One is risk assessment, other one is internal control and the other one is materiality. So three aspects of this chapter are there, and risk assess, all these three terms, whatever you are able to see here, whatever phrases that you are able to see here, these are nothing new actually. These terms we are all well aware. We know about risk assessment. We have already come across the term internal controls. We have already come across the term materiality. Even if you just look from the marathon perspective also, from day one revision, whatever we have done, at various places we have come across this term risk assessment. At so many places we have come across this term internal control, and at so many places we have come across this term called materiality. At various instances we have come across, and even we have a basic understanding of these three terms also. Even we have a basic understanding of three terms also. Now we need to dig deeper and get a proper understanding, get even a better understanding of these three concepts in a detailed manner. So first I will talk about risk assessment, then I will talk about internal control, then I will talk about materiality. So first let us talk about risk assessment. So guys, if you remember, the first and foremost procedure, which I will do in the audit is risk assessment procedure. Risk assessment procedure I am going to do. So what happens in the risk assessment procedure? If you remember the discussion, whatever we had in Sep'25, in the risk assessment procedure, we try to obtain an understanding of the entity, we try to obtain an understanding of the environment, we try to obtain an understanding of entity's internal controls. These three things we are going to understand now. So what is the purpose of understanding the entity, understanding the environment, understanding the internal controls? There we have told that our objective is to identify and assess the risk of material misstatement. So we will come to that risk of material misstatement part later. But in the audit, significant amount of time, we as auditors, significant amount of time we are spending on assessing the risk, analyzing the risk, identifying the risk, doing an analysis of the risk. Significant amount of time we spend in audit on risk matter. So why do you think risk plays such a crucial role in the entire audit? And before I talk about what role risk is going to play in the audit of the financial statements, but first let us try to understand what is the risk in audit, what risk auditor will face by doing the audit. So if you remember the definition of the audit or the overall objectives of the audit, so as an auditor, your ultimate responsibility is to express and is to obtain reasonable assurance whether financial statements are free from material misstatements, and also to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework, arrive at a conclusion and express that opinion, right? This is what my objective. So now you tell me, if there is a chartered accountant in practice and if he has taken up to do some audit engagement for his clients, do you find any risk he is taking by accepting that audit engagement? The chartered accountant in practice, if he has come forward, if a client has come to him and asked him to do some audit engagement for him, and the auditor has told, yes, okay sir, I will do the audit engagement for you. So like this, if the auditor has accepted to do the audit engagement for any client, is he taking any risk there? By doing the audit engagement, will the auditor face any risk? Yes, 100% auditor is going to take some risk. So if I have to put it in simple terms, what is that risk which auditor is worried about is the risk that he might give an inappropriate opinion. The risk that he might give an inappropriate opinion. So whatever opinion auditor has given on the financial statements, that risk, that opinion could be wrong. That opinion can go wrong. That risk that auditor will generally face in kind of every audit engagement, and that risk we give a technical name called audit risk. So what do we call that risk as? Audit risk we are going to call it. So what is audit risk? So if I define it as per the standards, if I define it, they have defined the term audit risk something like this: risk of expressing an, so let me show it here. They say that it is a risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. So what they have told, it is a audit, how the audit risk has been defined: the risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. That means financial statements of the client are materially misstated, but if the client is giving if the auditor is giving an inappropriate opinion there, that risk we call it as audit risk. Sir, what are they trying to say here? First thing they say, financial statements are materially misstated. Guys, you tell me, if the financial statements are materially misstated, if there is a material misstatement in the financial statements, what is the appropriate opinion? What should be the appropriate opinion? You tell me. If the financial statements contain a material misstatement, what should be the appropriate opinion? See, the appropriate opinion should be, auditor should have given a modified opinion, either qualified, adverse, disclaimer, whatever it is. If the financial statements contain a material misstatement, the auditor shall give a modified opinion. But I am saying that auditor is giving an inappropriate opinion. Appropriate opinion is modified, but what I am trying to say here is auditor is giving an inappropriate opinion. That means what auditor is doing? Auditor is giving an unmodified opinion. Instead of giving modified opinion, auditor is giving inappropriate opinion, which is he is giving unmodified opinion. So that means when modified opinion is appropriate, if the auditor is giving an unmodified opinion, when he is supposed to give some negative comment in his opinion, when he is supposed to say that financial statements do not give true and fair view, or accept certain items of financial statements give true and fair view, when he is supposed to give a negative comment, but what auditor is saying is, by giving unmodified opinion, he is saying that financial statements are completely giving a true and fair view. Which is wrong or not? Definitely wrong, when you should have told something is wrong. But if you are saying financial statements are giving true and fair view, on the basis of your audit report, if someone invested their money in the company, trusting that you have given an unmodified opinion, later if that fraud or error comes into public domain, share price will collapse and ultimately the users are going to suffer the huge losses. So because of your opinion, someone has taken a wrong decision. Don't you think later regulatory authorities will come and question you? You will be held legally responsible. You have to be answerable for your acts. Yes or no? So that risk we call it as, in audit terminology we call it as audit risk. So the risk of auditor's opinion going wrong when the financial statements are materially misstated. That means when modified opinion is appropriate, but the auditor is giving unmodified opinion, that we call it as audit risk. Now let me give you another scenario. Financial statements are not materially misstated. Take a typical scenario where financial statements are not materially misstated. There is no material misstatement in the financial statements, or even though there is a misstatement that is not material. Either there is no misstatement at all, or there is a misstatement which is not material. So if there is no material misstatement in the financial statements, what should be my appropriate opinion? What should be my appropriate opinion? So my appropriate opinion should be unmodified. If the financial statements are not containing material misstatement, my appropriate opinion should have been unmodified opinion. But what auditor is doing is, he is giving a modified opinion. He is giving which opinion? He is giving a modified opinion. Might be he found one small misstatement which is not at all material. If you look from the entire financial statements perspective, that misstatement is not material. But still he is very paranoid auditor. So he's very much worried. He's having a lot of concerns. He's very prudent auditor. Even that small misstatement also he has thought it as very bigger, and he gave a modified opinion. So can this be termed as audit risk? No. The second scenario will not come under audit risk. Why? Because the definition says the risk of expressing inappropriate opinion when the financial statements are materially misstated. That means when modified opinion is appropriate, if you give unmodified opinion, that only will come under audit risk, but not the other way around. If you give modified opinion when unmodified opinion is appropriate, that will not come under audit risk. This even if you go by the definition, even if you think from practical perspective. Why? Because see here, if unmodified, where you should have told financial statement should have given true and fair view, you are saying that except some items something is wrong. Except some items financial statements are giving true and fair view. See here you are acting little bit more carefully. By giving a modified opinion, you are acting more carefully. Because of this, the user will not make any wrong financial decisions. He will not fall into loss. But you all might get it out. Sir, if I give modified opinion when unmodified opinion is appropriate, my client will become unhappy. No, let him be unhappy. What he will do, sir, if he feels unhappy, he will not appoint me for the next year. You will lose a client. So losing a client is a business risk. Losing a client is a business risk which is not coming under audit risk. So when I say audit risk, that refers to such a risk which auditor will face from a legal perspective. But if you give modified opinion when unmodified opinion is appropriate, that is in the second case, you are not going to face any consequences legally. You might lose a client, you might lose your reputation, etc. That is a business risk. Audit risk does not include the business risk. Audit risk does not include business risk. Now, a few more things. What the standard says is, see, this audit risk, assessment of audit risk, all that discussion has been given under SA 315. And SA 315 says that audit risk is comprising of two components. Audit risk is comprising of two components. Audit risk happens because of two components. So one is risk of material misstatement and the other one is detection risk. Audit risk contains two components. Audit risk happens because of two components. One is risk of material misstatement and the other one is detection risk. Now let us try to understand what do you mean by risk of material misstatement and what do you mean by detection risk. Let us try to understand it. So risk of material misstatement. What is risk of material misstatement? They say that risk of material misstatement means the chance of happening of misstatement even prior to the audit of the financial statements. What do they say here? The chance of happening of risk means what? The susceptibility, the probability. The chance of happening of misstatement in the financial statements even prior to the audit, which is something management created risk. Auditor has nothing to do with whether audit happens or not. This risk will always be there. Like say for example, in an organization, in some company, like I am conducting audit of one supermarket, my client company is not having internal control. See, if the client company is not having internal control, don't you think there is a possibility of happening of misstatement? Yes, that I call it as risk of material misstatement. And you tell me, am I responsible for that risk as an auditor? No. Will that risk be there only because audit is happening? No. Whether audit happens or not, if there are no internal controls, there is always a possibility of theft. So that risk, we call it as risk of material misstatement, the chance of happening of misstatement in the financial statements even prior to audit. Whether audit happens or not doesn't matter. This risk will always be there. This risk is something which is created by the management. Auditor is not responsible for the creation of this risk. But what auditor will do, sir? If you are telling it is something, the risk which is created by the management, auditor is not responsible for this risk, then what is auditor's responsibility regarding risk of material misstatement? The standard says that the auditor's responsibility regarding risk of material misstatement is to identify it. You can't control it. You have to just identify it and assess it. You have to find it out and analyze. That too, how can I identify that risk of material misstatement? By performing the risk assessment procedures. By performing what? Risk assessment procedures. So as an auditor, you can't control the risk of material misstatement. You can only identify it. You can only assess it. That too by performing risk assessment procedures. So whatever it is, the risk of happening misstatement in the financial statements even prior to audit, that I am going to call it as risk of material misstatement. And the standard further says that this risk of material misstatement can further happen because of two more components. One is inherent risk and the other one is control risk. Risk of material misstatement once again happen because of two components. One is inherent risk and the other one is control risk. So what is inherent risk? What is control risk? So when I say inherent risk, they define the term something like this. If you look at from the material, they say that susceptibility of an assertion to a misstatement that could be material either individually or in aggregate, assuming that there are no related controls. That means in certain areas there will not be any internal controls to prevent a mistake from happening. Such a risk I am going to call it as inherent risk. So there are no internal controls. Generally, these kind of risks are unavoidable in nature. There will be certain areas in the organization where those areas will not be fit for implementing internal controls at all. So such a risk we call it as, because of absence of the internal controls, there is a possibility of happening misstatement. That risk we call it as inherent risk. Like if I have to give you one example, take an industry which is highly sensitive to the changes in the market. Take some company which is highly sensitive to the changes in the market. Like for example, if you take the mobile phone industry is such an industry which is highly sensitive to the changes in the market. If the mobile phone manufacturing company doesn't bring a new product into the market which is having latest features, very soon it will be thrown out of the market. Like Nokia, one example we have, and so many other appliance companies, electrical appliances company, they have also tested the waters in the mobile phone company. Like Videocon, they have tested their grounds in mobile phone industry. LG, they have also tested their market in the mobile phone. But you tell me, are they in the market still today? No. Why? Because they are very sensitive to changes in the technology. The product mobile phone is very sensitive to changes in the technology which they are not able to accommodate, and that has made the companies to go bankrupt. So like this, there is a risk that some misstatement can happen in the financial statements, and to prevent that risk, we can't implement any internal controls also. Such a risk we call it as inherent risk. Then we have something called control risk. The name itself says there is a control. There is one area where it is fit for implementing internal control. Even control has also been implemented, but that control has failed miserably. Sir, in what aspects the control has failed? The control has failed either to prevent a fraud or error from happening, or even to detect a fraud or error that might have failed, or even that might have failed to correct a misstatement. So there is an area fit for internal control. Organization has implemented internal control also, but that internal control has failed to prevent, detect or correct a misstatement on a timely manner. That risk we are going to call it as a control risk. So whatever it is, inherent risk and control risk, both put together, they will lead to risk of material misstatement, which is completely management created risk. Auditor can't control it. He can only identify and assess it by performing risk assessment procedures. Then what about detection risk? Now this is something which is under auditor's control, for which auditor will be responsible. So detection risk is a risk that the audit procedures performed by the auditor might not be able to detect a material misstatement which is already there in the financial statements. So basically, as an auditor, if we are performing audit procedures, what is our objective of performing audit procedures? So by performing audit procedures, we want to obtain sufficient and appropriate audit evidence whether there are misstatements or not. Now take a typical scenario where there is a material misstatement in the financial statements. As an auditor, you are supposed to perform audit procedures to find it out. You performed audit procedures, but unfortunately your audit procedures were not able to identify a misstatement which happened in the financial statements. That risk we call it as detection risk. And if you have understood the concept clearly, you would have realized that detection risk is something which auditor himself has created. There's something which is depending on auditor's ability. If the auditor can plan proper audit procedures, if the auditor is very careful in doing the audit, he can control the detection risk. On the other hand, if the auditor behaved negligently, then his audit procedures will not be able to identify material misstatement, then the detection risk will be higher. So whatever it is, the risk that audit procedures performed by the auditor might not be able to detect a material misstatement in the financial statements, that we call it as detection risk, which is something which is in the auditor's control. Whereas risk of material misstatement is a risk which is created by the management. Auditor cannot have any control over it. He can only identify it and assess it. Clear? And there's one more aspect here. Between the components of the audit risk, there is an interrelationship. Between the risk of material misstatement and detection risk, we have a relationship. What is that relationship? Is inverse relationship we have. Which kind of relationship we have? Inverse relationship we have. So when the risk of material misstatement is high, the auditor should perform more procedures. When he is performing more procedures, he will detect more misstatements. When he is detecting more misstatements, he will try to when he is detecting more misstatements, he is keeping the detection risk at a low level. So like this, there exists an inverse relationship between risk of material misstatement and the detection risk. So whatever it is, this is what the concept of the audit risk. Now, I would like to talk about one more aspect. The standard says that when you are performing risk assessment procedures, you will identify risk of material misstatement, but the standard says you need to identify that risk of material misstatement at two levels. The standard says what? You need to identify that risk of material misstatement at two levels. So what are that two levels of risk of material misstatement? They say one is you have to identify risk of material misstatement at the financial statement level, and the other one is you have to identify the risk of material misstatement at the assertion level. You have to identify the risk of material misstatement at the overall financial statement level, and also we need to identify risk of material misstatement at the assertion level. Sir, what do you mean by risk of material misstatement at the financial statement level? What do you mean by risk of material misstatement at the assertion level? So risk of material misstatement at the financial statement level means such a kind of risk which is having a potential to cause a material misstatement in the entire financial statements. If there is a risk in the organization which is having the potential to cause a misstatement in the entire financial statements, that risk we call it as a risk of material misstatement at the financial statement level. And if we find some risk in the financial statements which is having a potential to cause a misstatement in only one or two specific assertions, or if I put it in other way around, I found a risk which is having a potential to cause a misstatement in just one or two items of the financial statements, that risk I'm going to call it as risk of material misstatement at the assertion level. So whatever it is, after performing risk assessment procedures as an auditor, you need to identify the risk of material misstatement, and that risk you have to classify it into two levels. Risk of material misstatement at the financial statement level, which is having the potential to affect the entire financial statements. Other one is risk of material misstatement at the assertion level, which is having the potential to cause a misstatement in just one or two items of the financial statements. Clear? Right. So this much is enough. For risk assessment procedures, this discussion is enough. Now what we will try to do is, we will try to go to internal control discussion. And one more thing they say here, in the risk assessment part, we will have one more concept. There is something called risk-based audit. So this also we'll try to quickly cover, then we'll proceed with the internal controls. So we have something called risk-based audit approach. So what is this risk-based audit approaches? See, this we already know. Generally, we do risk-based audit approach only, just they are giving a name for this. See, say for example, if you are conducting audit of the client X Limited, and say for example you have to complete the audit with 10 days and for with the 10 staff, 10 days of time you have, 10 days of staff, 10 people you have for the purpose of completing the audit. Now I will give you two options to choose from. If you have to do the audit of this entity, I will give you two options. I will give you two approaches. Tell me which one you will choose. So X Limited client audit, we have 10 engagement team members and 10 days of time for completing the audit. Approach 1, approach 2. In approach 1, what I will do is, since I have 10 days of time, 10 engagement team members, I have 4 areas to cover: assets, incomes, expenses, liabilities. I have 4 areas to cover. So after covering all the 4 areas, I have to form a conclusion and give the reporting. So what I have done is, since I have 10 days of time, I will do one thing. For every area, I will allocate 2.5 days. Equally, I will allocate 2.5 days of time for each and every area. And also I have 10 resources, no? So 10 resources, I can't divide it to one person, I can't divide it to half, right? So let us say 8 resources I have. 10 days I have, 8 resources I have. So now what I have done is, two persons I have assigned it to each area. Equal allocation I have done. This is approach 1. Then I have approach number 2. In the approach number 2, what I have done is, since I have 10 days of time, first what I have done is, 1 day of time I have performed on risk assessment procedures, and I identified the areas where there is a risk of material misstatement. So I performed the risk assessment procedures. By performing risk assessment procedures, I identified the risk of material misstatement in each and every item of the financial statements, and I identified in which areas risk is high, in which areas risk is low. So I came to know that in the area of expenses and liabilities, the risk of material misstatement is very high, whereas in the area of assets and incomes, the risk of material misstatement is low. So out of 10 days, 1 day is already over. Now I have 9 more days. So now in that 9 more days also, I can't plan the audit. I can't do the audit till last day. So 1 day I want to keep it for conclusions. 1 day we have to discuss all the things. So last day we have to discuss all our findings and we have to give our conclusions, prepare the report. So I have 1 day has gone in the name of risk assessment procedures, 1 day at the end for conclusions. So balance I have 8 days. Now what I am doing is, these 8 days I have to cover 4 areas: assets, incomes, expense and liabilities. And as I have told, expenses and liabilities have a high risk of material misstatement. So what I have thought is, since expenses and liabilities have a high risk of material misstatement, I will allocate more amount of time here. I will allocate more amount of time here. 2.5 day of time I will allocate. So I have balance 80 days. In that balance 80 days, 5 days are over. So 5 days I have allocated it for expenses and liabilities because the risk is very, very high there. Now whatever balance 3 days I have, there 1.5 day I have spent it on assets, 1.5 day I have spent it on incomes. So now totally 8 days I have utilized. After the completion of 8 days, I will have the findings. That last day I will discuss the conclusion and form an opinion. So now I have given you two approaches. Approach 1, what they have done, I have told. Approach 2, what should be done, I have told. You tell me, if you are in the position of auditor, step into the shoes of the auditor and tell me, if you are in the chair of the auditor, if you are in that position of the auditor, which approach do you think is more better? Which approach will give you better results? Which approach where you, what is the approach where you will go, where you will not go wrong? So which is the effective process? I think you will say the second approach is somewhat better approach. That means we are basically driving our audit. Basically, we are driving our audit procedures, not randomly. We are driving our audit procedures, which areas we have to focus, what should be our attention, how we have to get the evidence, how we have to form the conclusion. Everything is driven on the basis of the risk we have identified. Such a kind of approach of the audit, I call it as risk-based audit. That's all. This is what we generally do also. So the second approach is nothing but what? For this they have given technical name, which is the risk-based audit, where our procedures, our decisions, our evidences gathering, everything was driven by the risk which we have identified. So that kind of audit we call it as a risk-based audit, and that's what we generally do there. So even though they give it as a separate concept, risk-based audit, but it is not a separate concept, it is what regularly we do. So what happens in the risk-based audit? First we analyze the audit risk. Then on that basis we set the materiality, and on that basis you can develop audit program. So if you see here, everything is driven by risk analysis. So audit should be risk based or focused on areas of greater risk to achieve the audit objectives. So remaining all the things they will try to say, and they say here 3 phases. There are 3 phases for risk based audit. First one is you have to assess the risk. Basically, as I have told, you have to understand you have to perform the risk assessment procedures, understand their internal controls, and you have to identify the risk of material misstatement. Then once you have identified the risk, then you have to respond to that risk. How you will respond to that risk? Like as I have told, by allocating time, by performing nature, timing and extent of the further audit procedures, by doing compliance testing, by doing substantive audit testing, by performing analytical procedures. Wherever risk is higher, there you spend more time. Wherever risk is lower, there you spend less time. So like that, the second stage in the risk based audit is you have to respond to that risk. Now the third stage is finally reporting. So once you have performed audit procedures, you will have observations, and depending on that observations, you will arrive at the conclusion. That conclusion you are going to give express in the form of a report. That report we call it as audit report. So that is the third phase. So like this, there will be 3 phases for risk based audit. First we will do risk assessment, then after we have assessed the risk, we will respond to that risk appropriately, and finally whatever our findings are there from that we will try to report it. Right. So one aspect we are done. Now let us try to understand internal control, the second aspect of this chapter, which is talking about internal control. So as we all are aware, internal control plays a very crucial role in the organization. Even in audit also, we allocate a significant amount of time towards internal control. Why? Because till now, whatever discussion we had, you could have observed throughout our course of audit, various places we do some work regarding internal controls. Like if you remember, if you understand the 3 basic procedures which we perform: risk assessment, compliance and substantive audit procedures. In the risk assessment procedures, we try to understand internal controls. In the compliance procedures, we will try to verify whether those internal controls we have understood are operating effectively or not. Yes or no? So in risk assessment procedures also, we are doing some work relating to internal control. In the compliance procedures, we are doing work only related to internal control. So out of the 3 specific procedures, in the 2 procedures we are associated with internal control. And even in the organizations also, from the management perspectives also, internal controls play a very crucial role. So from the management perspective also, internal control plays a very crucial role, and even from the auditor's perspective also, internal controls are going to play a very crucial role. Now what exactly is the meaning of internal control? What exactly is the meaning of internal control? So SA 315 has defined the term internal control. So how they have defined the term internal control is, it is any process which is designed, implemented, and also maintained by whom? By either those charged with governance, management, or other personnel. For what purpose this process has been designed, implemented, or maintained? To provide reasonable assurance regarding achievement of entities' objectives. So every organization, every entity will have an objective, and every entity needs assurance that it is going to achieve its objective. To provide that reasonable assurance that yes, entity, you can achieve your objectives, we need to have some processes which are designed, implemented, and maintained by management, those charged with governance, and other personnel. Those processes we are going to call them as internal control. Like appointment of security guards is a simple example of internal control, or installing a CCTV camera is a simple example of internal control, or having an approval mechanism, authorization mechanism before any entry can be recorded in the books of accounts. It has to be approved. Or the most common internal control which we see in the industry, segregation of duties, not keeping the entire end-to-end responsibility in the hands of one single person. Divide the different tasks in an activity among different people so that no one person will have control over entire activity. Why? Because if a single person is having control over the entire activity, there are more chances for manipulation. So that's why cashier, accountant duties will be separated. Store in charge and storekeeper duties will be separated. Fixed asset record keeper and fixed asset stock maintainer, so that the responsibilities will be separated. So this segregation of duties is also one more important internal control. So like that, any process which is getting designed to provide reasonable assurance regarding achievement of entities' objectives, we call it as internal control. But when I talk about specific objectives, you take any internal control. If I talk about specific objectives, when I look into specific terms, every internal control will try to fulfill at least one of the 4 specific objectives. Every internal control will try to fulfill at least one of the 4 specific objectives. Sir, what are that 4 specific objectives? Number 1, reliability of financial reporting. So some internal controls will work with the objective of making the financial statements more reliable. Some internal controls will work with the objective of So some internal controls will work with the objective of making the client's operations more efficient, more effective. Some internal controls will work with the objective of safeguarding the assets, protecting the assets. Some internal controls will work with the objective of ensuring the compliances with the laws and regulations. So when you look from the specific perspective, any internal control you take, that will try to fulfill at least one of these 4 objectives, and there will be some internal controls which will try to fulfill all the 4 objectives also. But we have to remember these are 4 specific objectives of internal control. What are they? Number 1, reliability of financial reporting. Number 2, efficiency and effectiveness of operations. Number 3, safeguarding of the assets. And number 4, compliances with the laws and regulations. Right. Next one. Sir, who is responsible for implementing internal control? Tell me guys, in the organization, it is whose responsibility to design, implement, and maintain the internal controls? Generally, management and those charged with governance. Auditor will not be responsible for designing and implementing internal controls. Auditor will only understand and verify them as a part of risk assessment procedures and compliance procedures. The responsibility for the implementation, designing, and maintenance of the internal control is always going to rest with management and those charged with governance of the client's organization. And as I have told, when I say scope of internal control, when I say internal control, those are not the control only relating to accounting. Internal controls, it doesn't include only the controls relating to accounting. It also includes, as you could see the statement here, the scope of internal control goes beyond accounting control. They are not just restricted to accounting matters. They go beyond accounting controls, and they also include administrative controls. They also include what? Administrative controls. Like for example, HR policies. Like if a person has to come, if an employee has to come inside the company, he has to show his biometric. He has to scan his biometric and he has to show his identity card. See, this has nothing to do with the accounting, but this is something relating to administrative matter. So like that, when I say internal control, it will not just be restricted to accounting control. The scope goes beyond accounting controls. It even includes administrative aspects also. But as an auditor, we are not worried about each and every control in the organization. We are worried about only the accounting controls. Those controls which have a direct relationship or some sort of association with the financial statements and books of accounts, those internal controls only auditor will be worried about it. Other controls, auditor might not get worried about them. So that's what they say here. And even if you see, that's what the complete summary here. Like if you see, in an independent financial audit, when you are doing audit of the independent financial statements, The auditor is primarily concerned only with those policies and procedures which have a bearing on assertions underlying the financial statements. So if you are doing audit, when I say internal control, many internal controls will be there, but you will not be associated with every internal control. You will only get concerned with those internal controls which have a impact, which have a relationship, which have a bearing on assertions on items of the financial statements, like those internal controls which are relating to safeguarding of the assets, those internal controls which are relating to prevention and detection of the fraud and errors, and those internal controls which are relating to accuracy and completeness of the financial information and accounting records, and those internal controls which are responsible for timely and reliable financial information. So as an auditor, if we are doing independent audit, we are mainly concerned with these internal controls only. And what we expect from internal controls relating to accounting system? Generally, whatever internal controls are there which are relating to accounting system and books of accounts and financial statements, from that internal controls, what are our expectations? So generally, what kind of policy should be there in the internal control relating to accounting system? So they should address the areas like that every transaction must have authorization. Any transaction which has been recorded in the books of accounts, that must have authorization. Authorization means what? Approval should be there. And all the transactions should have been promptly recorded. Every transaction should have been correctly recorded, that too in a timely manner it should have been recorded. Such policy should be there. And all the assets should be safeguarded. All the assets should be protected from unauthorized access. And even those assets should be verified at reasonable intervals, nothing but physical verification we call it. Think about what do we call this? Physical verification we call it. So you take accounting controls, generally we expect accounting controls to fulfill these objectives. Then we have one important concept called limitation of internal control, which means that no matter how effectively organization implements internal control, no matter how effectively organization implements internal control, they might be making use of best resources, best systems, best experts they have hired for implementing internal control system. But no matter how effectively an organization implements the internal control system, still internal controls can only provide reasonable assurance regarding achievement of the objectives. Internal controls will not give a guarantee that entity's objectives will be 100% achieved. That means, like the way audit can only give reasonable assurance but not absolute assurance, even internal controls also can give only reasonable assurance but not absolute assurance. Even internal controls also can't give absolute assurance. Why? Because like the way audit suffers from some inherent limitations which are unavoidable in nature, even internal controls also suffer from some limitations which are of such a nature that they are unavoidable. No matter whatever you do, those limitations will always be there. Since the process of auditing is suffering from inherent limitations, we can't obtain absolute assurance. Similarly, internal controls are also suffering from some inherent limitations, because of which they can't give guarantee, they can only give reasonable assurance. Now, what are that inherent limitations? What are that limitations of internal control? Why even after effectively implementation of internal controls also they can go wrong? Number one, cost exceeding the benefits. See, implementing internal controls is not a simple affair. It involves a lot of cost in the form of resources, cost in the form of systems, cost in the form of people. So implementing internal controls is not that easy. It is going to be a costly affair. So that's why what some organization will do is, in designing part, they will do a master design for the internal control, but they will not put into action. Why? Because when they start implementing, the reality hits very hard. There they will realize that cost is exceeding much, and whatever they have designed, that they will not implement. Halfway implementation they will do, because of which internal controls can fail. Next one, internal controls we can generally plan only for usual transactions. So whatever routine transactions are there, for that routine transactions only we can plan for internal controls. We can't plan internal controls for unusual transactions. So sometimes those transactions which don't happen in the normal course of business, we might have to do it. For that we can't implement internal controls, so that also in those transactions mistakes can happen. Or collusion. One of the most important problem why internal controls are failing in the organization is collusion. Those people among whom the segregation of duties has been done, to ensure that no one will have control, with a very noble intention, we divide the responsibilities among different people. But what these people will do is, these multiple people collude with each other, and they might make the internal control fail altogether. Like cashier and accountant might collude with each other, and they can make the internal control go wrong. So collusion will always be possible, which can make the internal control fail. Or misuse of authority, generally top level management. Like if you remember, when we discussed the SA 240, there we have read one point. Management in every organization will always have the position to override the internal controls. since management are the people who design the internal controls, they also can override the controls in whatever manner they want, and in some organizations some management has misused their power, because of which internal controls can go wrong, or even manipulation of assumptions and judgments. This we have seen in SA 540. Sometimes the management, because to achieve a desired result from the financial statements, they make wrong estimates, they make wrong assumptions. Because of that also internal controls can fail. Intentionally they will make wrong assumptions and wrong claims, because of which internal controls can go wrong. So these are the limitations because of which internal control can only provide the reasonable assurance, they can't give absolute assurance. So 5 such limitations they have told. What are they? Number 1, cost is exceeding the benefits. Number 2, it cannot handle transactions of unusual nature. It can lead collusion among the people can happen. People can misuse their authority or power, and also there could be a manipulation happening in case of judgments and assumptions. Then we have one broader question which is talking about what is the structure of internal control, or what policies and procedures must be covered in the internal controls. This I will tell you in brief. Generally, when I say internal control, in that internal control, what we generally expect. So if you see here, every one of the most common policy which will be there in majority of the internal control is segregation of duties. One of the most common policy which will be there in every internal control is segregation of duty. So what is segregation of duty? So the work is divided in such a manner that no one single person is having control over the entire task. It will pass among different people. So that activity we call it as segregation of duties, and it is one of the most common feature. It is one of the most common policy and procedure which will be there in every internal control. So segregation of duties. Generally, what kind of duties will be segregated? Number 1, authorization of transactions, execution, physical custody, maintenance. So these 4 activities should never be kept in the hands of one single person. They should be divided. Which 4 activities? Authorization, execution, physical custody, maintenance. So all these 4 activities should never be kept in the hands of one single person. They should be divided. So that is one of the most common feature. And when I say segregation, in that also one more aspect will also come: rotation of employees. Even one employee should not be kept in the same job for a longer period of time. After a certain period of time, his job role should be changed. This is typically very important for those people who are engaged in the finance roles. That's why tomorrow, if you become a chartered accountant and go to the industry, go and join some company, you will not be kept in the same position for longer. So they will rotate your job after 2 years, 3 years. They will change your department. Why they will change your department is why? Because the longer you are stuck into one role, the better people you control, the more influence you will have, more chances for committing the fraud. So just segregating the duties alone will not be enough. Even you need to rotate the employees also. Next, one more common policy which will be there in every internal control is authorization, approval mechanism, delegation of authority. So you should not make a person just like that pass an entry. If you take accountant should just like that not pass an entry. There should be a mechanism where an accountant can pass the entry and concerned manager can approve. And also that approval powers also you should not keep it in the hands of one single person. There will be something called delegation of authority. If I give you one example, check payment signing authority. So if you look at the organizations, they will have policies like up to 10,000 cashier himself can sign. Up to 1 lakh rupees finance manager can sign. Up to 10 lakh rupees finance head can sign. Up to 1 CR finance director can sign, and more than 1 CR CFO should sign. So like that, delegation of authority should be there, and there should be authorization. That is one more policy. And there should be adequate records and documents. One more aspect of internal control is one more common policy which we find in internal control is maintenance of records. If you are doing any transaction, in that transaction, whatever documents are getting generated, all that documents should be properly recorded. Like for example, if you take a simple example of purchase transaction in organizations, in big organizations, they will have this purchase internal control procedure. So if a purchase is taking place, they will have an internal control where multiple departments will be involved, multiple documents will be generated. Starting with purchase requisition note, purchase order, invoice from the supplier, gate pass, inspection report, GRN, and finally entry. So like this, if you take any transaction, it goes through multiple stages, it goes through multiple departments, and multiple documents will get created. All that document should be adequately recorded. So in most of the internal controls, you will also find this policy where they are making steps for, where they are taking steps for recording of the documents. Why? Because tomorrow if something has gone wrong, if we have to find out where something has done, where something has gone wrong or who has done something wrong, with that documentation only we can be able to find it out. Then we have accountability and safeguarding of assets. One more common policy which will be there in any internal control is safeguarding of the assets, protecting the assets of the company. So either intangible assets you take, tangible assets you take. We will have here physical custody like security guards, CCTV cameras, biometric access. So all these are examples of the policies which are related to the objective of safeguarding of the assets. And then finally, there should be independent checks. Just implementing the controls alone will not be enough. Periodical checks also should happen. If I have to give you an example of independent checks, we can give the example of internal audit. Right? So these are the common policies and procedures in most of the internal controls. Then after that, this is one more aspect. What are various components of internal control? From here also many times the question has been tested. So components of internal control, one of the important concept. The standards say that there are 5 components of internal control system. There are how many components of internal control system? 5 components of internal control system are there. So understanding these 5 components is little important. So the standards say that there are, if you want to implement internal control in the organization, any organization, if they want to implement internal control, or if they want to make sure that internal controls in their organization are working effectively, then they need to take care of 5 components. Sir, what are that 5 components of internal control? The first one is control environment. The second one is entities risk assessment process. The third one is control activities. The fourth one is information system including related business process relevant to financial reporting. And then finally monitoring. So I will give you a brief of each and every component, what exactly will happen in each of the component. So if an organization wants to implement internal control, it must have control over 5 aspects, or it must go through 5 components or 5 stages also you can call it. So repeat everybody along with me. So what are the 5 components of internal control system? Number 1, control environment. Number 2, entities risk assessment process. Number 3 is control activities. Number 4 is information system including related business process. And number 5 is monitoring of the controls. So let us try to understand what happens in each of the component. What does each of the component mean? First thing is control environment, which means that if you want to implement internal control in the organization, say for example, I'm a company owner, I'm a CEO of some company. In my company, I want to implement some internal controls. And when I'm implementing internal controls, what will be my expectation? Will I want my controls to work effectively, or will I not want my controls to work effectively? Definitely, I want my controls to work effectively. See, if I want my controls to work effectively, first I should create a good culture in my organization. A culture of honesty I have to create. A culture of ethical behavior I have to create. Unless and until I create a culture of honesty and ethical behavior in the organization, unless and until I have a good culture in my organization, can you expect the controls in my organization to work effectively? No matter how much systems I decide, no matter how much people I recruit, no matter how many experts I involve, if I don't have a good culture of ethical behavior in the organization, will I be able to implement? Will my internal controls produce their objectives? Definitely not. So that is the first stage. Before any organization starts looking for internal control, they need to have a good control environment, good culture they have to create. So how they can create a good culture? Number 1, by way of communication of integrity and ethical values. So as a top level management, you have to communicate to your staff that how important it is to remain integrity, how important it is to follow ethical values. You have to continuously communicate. See, just communication alone will not be enough. Even you have to enforce, you have to put into action also. Then commitment to competence. As a management, you should always show your commitment to capabilities. When you are recruiting, show your commitment to capabilities. When you are promoting, show your commitment to capabilities. So don't recruit incapable people, don't promote unnecessary people. So like that you should not do. As a management, you should always show that you are committed to the capabilities. So that you have to demonstrate. By that, good culture will be created. And those charged with governance should participate more. When I say those charged with governance, they are top level management, right? So when I say someone is a top level management, they should not always sit in their cabins and never coming down on the floor. They should not do it. So once in a while, frequently, they should interact with the people, and from that they have to get the information. The more they participate in the business, the better culture they will get created. And also, the management should have a good philosophy and an operating style to promote a good culture. And they should have proper organizational structure, proper hierarchy should be there. Who is top level management? Who is middle level management? Who is low level management? Who should report to whom? Who should create? Who should approve? Proper organizational structure should be there. Then you have to properly assign your authorities and responsibilities. So when you are assigning the responsibility, when you are giving the power for authorization according to their roles and responsibilities, according to their capabilities, responsibility assigning and authorization assigning should happen. And even when even in your human resource policies, even in your HR policies also, the integrity and ethical value should be reflected at the time of recruiting, at the time of training, at the time of promoting. Even in your HR policies also, you have to show your commitment to the integrity and ethical values. So the first step in creating any internal control is creating a good control environment, creating a good culture and ethical behavior. And how that can happen? By way of communication and enforcement of integrity and ethical values, by showing your commitment to competence, by more participation by those charged with governance, by setting management proper philosophy and operating style, by establishing proper organizational structure, by properly assigning the responsibility and authority, and even having HR policies appropriate. So whatever it is, first you will create the good culture. See, once we have created the good culture, then what organization should do is they should do the risk assessment process. See, like the way we auditors will do first risk assessment procedures now. Why we do risk assessment procedures? Because we want to identify the risk of material misstatement. Why we are identifying risk of material misstatement? So that we can perform better audit procedures, right? Like the way we are doing risk assessment procedures to identify the risk in the organization, even management also should study their own organization to find out the risk. Why? Because see, one basic logic we have to understand here, why any organization will implement internal control to prevent the risk, right? To mitigate their risk. So there is a possibility of something going wrong in the organization. To prevent that thing from going wrong, they implement internal controls, right? See, if an organization wants to implement internal control, first they should know where is something going wrong in their organization. They should study their organization, and first they have to find out where something can go wrong. That means before they can implement internal controls, first they should know what is going wrong in the organization. For that purpose, the client's management themselves should do entities risk assessment process. Study their own organization and find out where there is a risk. And the management should keep in mind that risk can happen because of various circumstances. Like sometimes there could be changes in the operating environment, like operating or regulatory environment, that could bring new risk. Sometimes new people might have joined the company because of lack of understanding of their processes. Then also some risk can happen. Or sometimes the client might have changed their information system. Sometimes they might have built up new softwares. They have changed their information system from Tally to SAP. This could also bring new risk. Or rapid growth. Sometimes what will happen is some kind of companies grow very rapidly, very altogether from 1x to 10x they will grow. So that rapid growth also will bring new risk. Why? Because the organization is not yet ready. You have grown beyond your capabilities. That will also bring new risk. New technology, when you are using a new technology, like for example, today companies are all adopting to this AI and all, that will also bring new risk. And the risk can arise from new business models, new products, or new activities. When you are launching a new product, when you are diversifying your business, when you have acquired someone, that will result into new risk. Or corporate restructuring. Now this is where mergers and acquisitions will come. Because of corporate restructuring, also new risk will arise. And even expanded foreign operations. When you are expanding your operations to a foreign country, there you might have to face the new risk, like foreign exchange fluctuation risk you might be required to face. Or sometimes new accounting pronouncements, like new accounting standards or accounting standards undergoing amendment. This also can bring new risk to the organization. So whatever it is, the management should study about their own organization and identify all the risk. So once they have identified the risk, then they have to start implementing the control activities. So this is where the actual implementation of the internal controls is going to happen. So now you should start implementing various control activities in different areas wherever you have identified the risk. Like number one, first what you can do is performance reviews. In some areas you can implement the controls of performance reviews, like comparing the actuals with budgets, comparing with the last year data. Any huge deviations you have to investigate, ask the concerned person why there are such huge changes. So in some areas you can implement control activities of performance reviews. In some areas you will have controls in the information technology itself. Like we have something called application controls, we have something called general IT controls. General IT controls are protecting the overall IT environment, whereas application controls will work on specific applications. So sometimes you might think of implementing controls in a IT environment. So today everybody is doing that only. Manual controls organization have stopped giving more importance. Now these days the organizations are giving more and more importance for technology related controls. And physical controls, at some places, in some areas you might be required to implement physical controls. Sir, what do you mean by physical controls? Like authorization, approval mechanism, periodical verification, appointment of security guards, installment of CCTV cameras. So in some areas you might feel it fit to implement physical controls. And in almost all the areas you might fit that segregation of duties is required to be implemented. So actual policies, actual control activities will start happening in the third phase of the third component. So first component, creating a control environment, creating a good culture of honesty and ethical behavior. Number two, studying the organization and finding out where there is a risk of material misstatement. Number three, once you have identified the risk, now you have to start implementing the control activities. And also you need to today implement information system, including related business process relevant to financial reporting and communication. So if you want to have strong internal control system, you need to have good information system, especially related to financial reporting. That means you need to have a good accounting software. Why? Because if you have accounting software, through that accounting software itself, we can implement internal controls. And if any lapses are there, proper communications also will happen if you have a proper accounting software in place. So the next component is you have to start exploring or investing in the information technology. So you need to have such an accounting softwares regarding information system, regarding financial reporting, which will identify and record all the valid transactions, and they will do proper classification of the transactions. They can do the proper valuation of the transactions. They record the transactions in the correct time period in which they have occurred, and even they can present properly the transactions. So you should use your client, if they want to implement internal control, they should start investing in such accounting system which can do all these activities. So invest your amounted money in information systems. And then finally, just having this alone, just implementing the control alone will not be enough. Periodically, we need to review whether the controls are working effectively or not. So with whatever objective we have implemented the controls, whether those objectives are met, is there any requirement to make any changes to the internal controls? Is there any requirement to update any policy regarding internal control? Or is there any internal control lapses? Do you require to amend it? So that continuous monitoring also should happen. So just implementing controls alone will not be enough. Only when you do monitoring, then only you will get to know whether controls are working effectively or not. So these are the 5 components of internal control. So if any organization wants to implement internal controls, they have to go through that 5 stages. Clear? Few more, two more concepts I will cover from the internal control. Then I will go with the materiality section. Okay. So one concept which I would like to cover is internal check system. From these things also, they are asking some questions these days. So what is this internal check system? See, internal check system means it is nothing but, if you ask me simply, it is other name for segregation of duties. Internal check system is just an other name for segregation of duties. So they say that even if you read the meaning also, you get the same thing. Organization of overall system of bookkeeping and arrangement of staff duties, so that no one person can carry out through a transaction and record every aspect thereof. And it is a built-in device where checking on day-to-day basis will happen. Which means that internal check system is actually a part of internal control. So internal control is a very broader perspective. Like I have told, in the internal control mechanism, authorization will come, segregation of duties will come, and their proper recording of the accounts will come. So like in the internal control system, these many things are there. One such aspect of internal control system is internal check, which I will say, which is not something new which we have to learn it all together. It is something which is very much similar to segregation of duties. So they say that in the internal check system, what we will do is, if a transaction is there, if an activity has been performed, now this activity will be spread across so many people. So many people will get involved in that activity. This activity will not be kept into control of one person. This work will be divided among different people from the starting to the beginning. And the work will be divided in such a manner that work of one person will be automatically reviewed by another person. So this person's work will be reviewed by this person. Now this person will add some work to that activity. Now this work will go to the next person. Now he will review the work of the previous person. Now he will do his part. Then the work will go to another person. He will verify the previous person's work. He will do his part, and then it will go to the final person. So like that, if the duties are arranged in such a manner that where the work of one person will be automatically reviewed by another person, where no one person will have control of end-to-end activity, that I call it as internal check system. That's why I say this is not just but other name for segregation of duties. Sir, what are the objectives? With what objectives internal check system will be implemented? Number one, to detect the errors and frauds. If at all any errors or frauds have happened, there should be early detection. You can't detect it after 1 year, 2 years. There will be of no use. So the main objective of internal check system is to detect the errors and frauds as early as possible, and to avoid and minimize possibility of commission and errors, to reduce the possibility of errors. And to increase the efficiency of the staff by not making one person responsible from end to end, since you are dividing the work among different people, their efficiency will get increased. And also to locate the responsibility, if at all something goes wrong, you should be able to find out who is the exact person responsible for that, and to protect the integrity of the business and to avoid the misappropriation. So these are the main objectives with which internal check system will be implemented. And if you want to make sure that internal check system will work effectively, you need to keep some considerations in mind. So if you want to make sure that you have designed internal check system, you have divided the work among different people in such a manner that work of one person is getting automatically reviewed by another person. But if you expect that internal check system to work effectively, then you need to have some considerations in mind. So what considerations in mind you have to keep? Number one, everybody in that internal check system should have a clarity of responsibility. What is their task? What is next person's task? That clarity should be there. Number two, you have to divide the work in such a manner that you are not overly dividing it. See, if you are dividing the work among 3 to 4 people, it is fine. You should not divide the same task among 10-20 people. It will unnecessarily create bottlenecks. So there should be proper division of work. Unnecessary excessive division you should not do. And even standardization, to the extent possible, you have to standard the process. See, generally we achieve that standardization by way of SOPs. Organizations will have something called SOPs. By way of that SOPs, organizations should try to achieve the standardization. And appraisal, periodically you have to review each person is doing the work properly or not, each person is reviewing the previous person's work or not. That periodical review also should happen. Okay, so this is what regarding considerations regarding effective internal check system. Then this is something general conditions pertaining to internal check system. This is once again repetition from all the above things whatever we have read. So that is the one general paragraph. Now one more last aspect which I want to cover from the internal controls is what are the various techniques for evaluation of internal control. So this is also one such important area. Techniques for evaluation of internal control. So if you want to evaluate the internal control, if you want to analyze the internal control, just give me one moment. Right. So if you want to evaluate whether internal controls in the client's organization is working effectively or not, so in order to do that evaluation, we have 3 techniques available. How many techniques we have available? So we have 3 techniques available for evaluation of internal controls. So what are that 3 techniques which are available for evaluation of internal controls is, the standard says we have something called internal control questionnaire, and then we have something called checklist, and then we have something called flowchart. So there are 3 techniques available for evaluation of internal controls. So what are the 3 techniques which are available for evaluation of internal control? Number 1 is internal control questionnaire, number 2 is checklist, and number 3 is flowchart. So we will try to understand each and every technique in a detailed manner. So first one, flowchart. First we will try to understand the flowchart. Sir, what is flowchart? The name itself says the auditor will try to understand the internal control and whatever processes are involved in the internal control, which and all departments are involved, which and all documents are generating, how the documents are getting circulated. So what auditor will do is, first he will try to get an understanding of the internal control process with all this linkages understood. Then whatever understanding he has obtained, after understanding, then whatever understanding he has obtained, that understanding he will try to do a pictorial representation, graphical representation he will try to do in the form of charts. Flowcharts we generally say it, right? So in the form of charts he will try to present the overall process of the internal control, whatever he has understood. That method we call it as flowchart. Now the key features of the flowchart is, flowchart is the most concise version of presentation of internal control. It is the most briefest way of presenting the internal control, and it will give a overview. By just looking at the flowchart, you get a one bird's eye view, overall comprehensive understanding you are going to get it by looking at the flowchart. And also it is going to take less time. It will take very less amount of time. You will understand internal control and develop a graphical presentation. So comparatively it will take less amount of time, and not just that, it is very easy to locate the errors in the case of flowchart. If there is any lapses in the internal control system, that we can easily locate it by looking at the flowchart. So flowchart is one common old traditional method to evaluate the internal control system. Then we have the two most commonly used internal control methods, internal control evaluation techniques, which are internal control evaluation is mainly happening through internal control questionnaire and checklist. Now, what is this internal control questionnaire checklist? What is this internal control questionnaire and what is this checklist? We'll try to understand it in a one single slot. We'll try to understand. We'll not have a separate discussion. In one lot, we will try to understand internal control questionnaire and checklist. See, both in internal control questionnaire and checklist, what will happen is there will be a series of questions. There will be a series of questions. Sir, prepared by whom? These series of questions will be prepared by auditor only. In both the cases, in both internal control questionnaire and in both the checklist, who will draft the questions? Auditor only will draft. Regarding what he will draft the questions? He will draft the questions regarding the elements of the internal control. He will draft the questions regarding the elements of internal control. And he will draft the questions in such a manner that answer will be either yes, no, or not applicable. He will draft the questions in such a manner that the answers will be either yes, no, or not applicable. He will not draft the descriptive questions. He will draft small questions where answers should be either yes, no, not applicable. If at all he wants, he can add the remarks column. One extra remarks column he can add, but mainly he will draft the questions in the format of yes, no, or not applicable. Now, sir, you are telling in both the cases series of questions will be there. In both the cases, auditor will draft the questions, and in both the cases, the questions will be in the format of yes, no, or not applicable. But how come these two methods are getting differentiated from each other is these two are getting differentiated from the perspective of who is going to answer that questions. See, if it is an internal control questionnaire, what I will do is whatever questions I have prepared, those questions I will go and give it to the management. Whose management? Give it to the client's management. Whatever questions I have drafted, those questions I will go and give it to the client's management and ask them to fill the answers and get back to me. Either the client's management will do it or their staff do it. I'm least worried. Just I will take the list of questions and go and give it to the management, hand it over to them, and I will tell them, sir, I need answers for these questions. Please give me the answers to these questions. Now, whether clients management themselves will do it or they will get it done from the staff, that I am least bothered, but someone from the management, someone from the client will fill the answers and give it back to me. And on the basis of whatever responses I have got, and on the basis of that responses, I will try to evaluate whether the controls are operating effectively or not. On the basis of responses, whatever I have got, I will try to evaluate whether the controls are operating effectively or not. So that I call it as internal control questionnaire. So then what happens in the checklist? In the checklist, what I will do is here also I will have a series of questions prepared regarding various aspects of the internal control, where the questions are either yes, no, or not applicable. Here also everything will remain the same. But the difference is in the case of checklist, these questions I will give it to my audit staff. Those questions I will give it to my audit staff, and I expect my audit staff or I expect my audit team to either answer them or follow them as instructions. I will expect in the case of checklist, I will call my engagement team members. I will say, boss, you go to the concerned area. Like for example, I have drafted questions in the area of cash. In the area of cash payments, I have drafted some 10 questions where I have left out one column for answers. So now what I will do is I will call my article assistant and I will say, boss, you go to the cash payments area, try to verify these questions and get back to me with the answers. So this article assistant, either he can treat them as questions to be answered, or even he can treat them as instructions which are required to be followed. Why? Because his partner is telling us to verify these 10 things and get back the answers. So you can call them as either questions to be answered or instructions to be followed. Whatever it is, my audit team will go to that concerned area, verify the aspects of internal control, get the answers to the question and give that answers to me, and depending on that answers, I will evaluate whether the controls are working effectively or not. So that is what happening in the checklist. So between internal control questionnaire and the checklist, the main point of difference is who is going to answer. In the case of internal control questionnaire, the client's staff or management will answer. In the case of checklist, the auditor's staff will answer. Understood? So this is what the brief of the differences between internal control questionnaire and checklist. They have given even examples also how the questions will be drafted in the format of yes, no, or not applicable. So just have a detailed understanding regarding it. Okay, clear and comfortable everyone? So this is what relating to internal control questionnaire and checklist and methods for evaluation of internal control. So if you remember this chapter, I have told in this chapter we have three aspects to be covered. One is risk assessment, other one is internal control, and the other one is materiality. So out of the three, we are done with the two. Risk assessment part we have completed. We have completed internal control part. Now we are left with one more last part, which is materiality, fixation, and all we have to discuss. And regarding risk assessment and internal control, whatever discussion we had, that is from SA 315, and how to fix the materiality, that discussion we have it in SA 320. Okay. So but I think it's better to take 2 minutes of break now. So we'll take just 2 minutes of break. After 2 minutes of break, we will continue our discussion with the fixing of the materiality, and then we will try to proceed further with the remaining chapters. Okay. So just 2 minutes of break. We'll be back in 2 minutes. Then we will resume our discussion. Okay. Right. Yeah. So sorry guys, my audio was off. Yeah. Thank you. Right. So now we are going to proceed further and try to understand the materiality related discussion. And this materiality related discussion was given in essay 320. So like the way as I was saying, a risk assessment topic is not something new to us, and even internal control topic is also not something new to us. These are the terms which we are already aware. On the same lines, even materiality, the term materiality is also not something which is new to us. This term materiality also we have come across in our earlier discussion. So what do you mean by materiality here? As I have told that materiality is one of the most important consideration. Materiality is one of the most important consideration which we have to keep in mind while doing audit. Why? Because the first and foremost objective of the audit says that as an auditor, you need to obtain reasonable assurance whether financial statements are free from material misstatements. That means as an auditor, we need not be concerned about each and every misstatement. We need to be concerned about only material misstatements. And as I said earlier, what is the meaning of the term material? Something which is significant, something which is major, something which is important. These are all the synonyms for the term material. But what is material? What is not material? It is highly subjective. Materiality is not something which is absolute term. We cannot define materiality in the absolute terms. Materiality is something which is highly subjective in nature. It changes from person to person, entity to entity, facts and circumstances of each and every case. It depends on the nature of the organization, industry to industry. So it will keep on changing. So there is no hard and fast rule. This much amount will be material. This much percentage will be material. There is no such hard and fast rule there. It all depends on the professional judgment of the auditor. And as we have seen that materiality, when we consider a misstatement as material, we consider a misstatement as material if it could influence the decision, if it influence the economic decision of users of the financial statements. So we are going to consider a misstatement as material if it could influence the economic decisions of users of the financial statements. Then we are going to consider that misstatement as material misstatement. If it is not going to influence if it's not going to have an impact on the decision of the users of the financial statements, then we don't consider them as material. See, now the question comes, okay, agreed, the materiality will be determined by the auditor using his professional judgment. Okay, but at least the standard should give me some approach, no? Ultimately, as an auditor, I will use my knowledge, experience and training and will decide what is material, what is not material. But the standard give me some sort of guidance, right? At least they should give me approach how to fix that materiality. Has the standard given that approach? Yes, the standard has given that approach. And what is the approach the standard has asked you to follow is, so for fixing materiality figure, first you need to determine percentage. First you need to determine one percentage. Sir, how much percentage? How much percentage? That is once again your professional judgment. So you use your professional judgment and arrive at some percentage. You can say a 2%, you can say a 5%, you can say 10%, you can say 20%, whatever it is. Use your professional judgment and determine one percentage. And whatever percentage that you have decided, that percentage should be multiplied with some suitable benchmark. Whatever percentage that you have decided, that percentage should be multiplied with some suitable benchmark. Sir, what could be a benchmark? A benchmark could mean different items. Benchmark could be any item of the financial statement. It could be profit, it could be turnover, it could be net worth, it could be total expenses, it could be total assets, it could be liabilities, whatever it is, any component or any item of the financial statements can be benchmark. So you have to choose one benchmark and you have to choose one percentage using your professional judgment. And if you multiply that percentage with the benchmark, you are going to get one figure. That resulting figure will be the materiality level decided by the auditor. That resulting figure will be the materiality level decided by auditor. Like for example, see once again here you will get it out. Sir, when you say benchmark, you are giving these many options. You are saying profit also could be benchmark, turnover could be benchmark, net worth could be benchmark, total assets liability could be benchmark, total liabilities could be benchmark. So you are telling that benchmark could be any of this, no, but how to choose one from this? Once again, professional judgment. Once again, professional judgment. So basically, in choosing that benchmark, various factors you will consider. In choosing that benchmark, various factors you are going to consider. Like you will consider the nature of the industry, to which industry audit you are doing, and in that industry, what are the users' expectations. Like for example, in the FMCG company, people are more interested to know about turnover. So if I'm conducting audit of FMCG company, I will take turnover. It depends on if you are conducting audit of an IT company, people in the IT industry are more interested to know about the profits. There I will take the profits as a benchmark. So it depends on nature of the industry and users of financial statements, requirements. It depends on requirements of applicable financial reporting framework. Sometimes there will be an indication the applicable financial reporting framework of what can be taken as a benchmark, or it also depends on volatility of the benchmark. It also depends on relative volatility of the benchmark, which means how frequently that number is changing. Say for example, for one company I am doing audit, I want to take profit as a benchmark. See, profit is somewhat constant. Year on year, it is making a progress. Like for example, for the last 5 years, if I observe, the profits are something like this: 50 crore, 60 crore, 70 crore, 80 crore, something like that. See here, the profits are less volatile. They are following one trend. They are following one specific trend. So here I can take profit as a benchmark. Why? Because it is not that much volatile. Now there is another company. If I look at their profits are something like this. In 1 year it was 10. In another year it was 40. In another year it was minus 5 crores of loss. In some year, once again they have made some 25 crores of loss. In next year they have made 30 crores of profit. So you tell me, if that is the nature of profits of the company, here the profits of the company are very volatile. Here profit might not be a suitable benchmark. I will go to some other benchmark, which is turnover. So like this, auditor will consider various factors. He will use his professional judgment and select one benchmark. That chosen benchmark will be multiplied with the chosen percentage. The resulting figure which you are going to get, you call it as materiality. Like say for example, using my professional judgment, I have decided 5%. And considering all the factors, I have taken profit as a benchmark. Now profit figure I have to take. Sir, from where I will take that profit figure? Okay, so all these factors you have considered. After considering all the factors, you have chosen that you will take the profit as a benchmark. But from where I have to take the profit figure? You all will say financial statements. But from which financial statements I have to take the profit figure? So very simple, guys. If you are doing the audit after completion of the financial year, at the time when you are doing the audit, financial statements are already ready. No need to look for any other sources. From the current period financial statements, you take the profit figure. But sometimes, as I have told, especially in big entities, we don't wait till the closure of the year to start doing the audit. We start it much earlier. During the course of the year only, we start doing the audit. See, if that is the case, in that case, current year financial statements will not be ready. Then you can take that profit figure. Then you can take that benchmark from last year financial statements, or even you can take it from budgets. If the budgets are there, from the budgets you can take, or if any latest interim financial statements are available, if any quarterly financial statements are available, from that also you can choose a benchmark. So once you have considered the factors, chosen the benchmark, now comes the question, from which source you have to select the benchmark. If the current year financial statements are ready, from the current year financial statements only I will pick. If the current year financial statements are not ready, then I will start looking for other sources like last year's financial statements, budgets, or even estimates, or even it could be interim financial statements. Now say for example, I am doing audit of the current year. By the time I am doing the audit, current year financial statements are already ready, and from the current year financial statements, the profit figure is somewhere around 500 crores. The profit figure is 500 crores. Now I have to multiply 5%, which is my chosen percentage. I have to multiply with that chosen benchmark. If I calculate that figure, that will come to 25 crores. So now 25 crores will be the materiality. What I will do is, whatever misstatements I have identified during the course of the audit, either individually or in aggregate, whether they are exceeding that materiality level or not, I will check. Yes, if the items are exceeding the materiality level, if the misstatements either individually or in aggregate, if they are exceeding the materiality level which I have fixed, then I will give modified opinion. On the other hand, if the misstatements are there, but when I calculated the amount, they are within that materiality level, then I will not give a modified opinion, I will give an unmodified opinion. Because misstatement is there, but that is not material. You are required to give a modified opinion only when the misstatements are material. Clear everyone? So like this, I have to select the bench. Like this, I have to decide the materiality level. And also the standard says one more thing. SA 320 says one more thing. You have to decide the materiality at 2 levels. What does the standard say? You have to decide the materiality at 2 levels. Materiality level for the overall financial statements, and so which we call it as overall materiality. We have to decide materiality at 2 levels. One is overall materiality and the other one is performance materiality. So as per the standard SA 320, we have to determine the materiality at 2 levels. One is overall materiality and the other one is performance materiality. Now, what is this overall materiality? What is this performance materiality? Let us try to have a quick look at it. So overall materiality is the level of materiality which is decided for the financial statements as a whole. for the entire financial statements, for the financial statements as a whole, if you are determining the materiality level, that we call it as overall materiality. On the other hand, if you are deciding the materiality level for each assertion or for each item of the financial statements, that we are going to call it as a performance materiality. Like for example, if I told that entire financial statements, I will consider them as misstated if they have 25 crores of misstatement. But if I keep this materiality level for the financial statements as a whole, sometimes in the individual items of the financial statements, like say for example, assets are there. In the assets, I have different items. Fixed assets are there, inventory is there, current assets are there, trade receivables is there, cash and cash equivalents is there. Now for the entire financial statements, overall materiality I have set it as 25 crores. But sometimes what will happen is in individual items, the misstatements could be smaller. But individually they could be smaller, but in aggregate they could be material. So, but I could miss it out individually when I look at them. Say for example, in fixed assets, I have a misstatement of 2 crore. It might look very immaterial for me, I will ignore. But if I combine with other misstatements in other areas, total misstatement could have gone beyond my 25 crore. So to avoid that kind of circumstances, what I do is for each item of the financial statement, I will keep the materiality level once again. Say for example, my fixed assets figure is 100 crore rupees. For that, I have multiplied 5% of materiality. So I will consider fixed assets as materially misstated if they have a misstatement of 5 crore rupees. So this materiality I have set for fixed assets alone, this I call it as performance materiality. And generally, performance materiality will be lower than the overall materiality. That means between overall materiality and the performance materiality, generally which figure will be higher? Overall materiality figure will be higher than when compared with the performance materiality. And few more things to talk about materiality. So generally at the planning phase, initial phases, we decide the materiality level. Whatever materiality fixation, whatever approach, whatever calculation I have told you till now. See, this generally we will do it at the planning stage itself. We decide the materiality also. So we decide the materiality generally at the planning stage of the audit. When we decide the materiality, we decide the materiality at the planning stage of the audit. But during the course of the audit, if required, you might revise your materiality level. No issue. During the course of the audit, if you want to revise your materiality levels, you can do it. Like the way we are making changes to our audit strategy, audit plan and audit program during the course of the audit, in the same manner, even you can make changes to your materiality level as and when the audit progresses. There is no hard and fast rule which says anywhere that whatever materiality that you have fixed at the beginning of the audit that you have to follow strictly till the end of your audit. There is no such rule. This materiality you can revise this, like the way we can revise audit strategy plan and program, even we can make changes to our materiality related decisions also during the course of the audit. SA 320 permits it. And whatever materiality levels you have decided, how you have decided it, what is your overall materiality, what is your performance materiality, have you revised the materiality? If yes, because of which reasons you have revised the materiality, all these things should form part of my audit documentation. All these things should form part of my audit documentation. Clear and comfortable, everyone? So this is how to fix the materiality. So SA 320 also we have completed. So we are successfully done with risk assessment, internal control and materiality chapter also, right? So now I will go to special standards. So I will do a revision of SRS first. Standards on related services I will try to cover first. So related services I will try to cover. Right. Fine. So first we will do related services. Then after that we will do standards on assurance engagements. SAE series will do. So first we will do SRS. Then we will do SAE. So first let me talk about SRS, standards on related services. So guys, if you remember, even as I mentioned earlier, if you are a chartered accountant in practice, you can do different kinds of engagements. One is we can do audit, which is a reasonable assurance engagement, that too of historical financial information. So there standards on audit will become applicable. Number two, you can do review, that too of historical financial information, which is the limited assurance engagement. And for doing this review engagements, SRE will become applicable. Standards of review engagements will become applicable. Then always you might not get associated yourself with historical financial information. We get associated with other than historical financial information also. Sometimes we might be required to do some engagements relating to other than historical financial information. See, when I say other than historical financial information, it could be non-financial information also. It could be future financial information also. Okay, so that engagements we are going to call it as that kind of engagements. For that kind of engagements, what will become applicable? SA will become applicable. But if you see all these three engagements, be it audit engagement, be it review engagement, or be it other than historical financial information, these all three are assurance. In all these three engagements, we are providing assurance. That means we are giving some form of opinion, some form of conclusion we are giving, and on the basis of that conclusion, users will form their decisions. Yes or no? So even audit engagement, review engagement, or if you are associated with other than historical financial information, in all these three engagements, we give some sort of assurance, some sort of comfort we will give it to the user. We are helping the users in the decision making. But always we need not do assurance engagements. Sometimes as a chartered accountant, we are not giving any assurance. We might be doing some engagement where we are not supposed to express any opinion. We might not be required to express any conclusion. Just we might be required to perform some agreed upon procedures. Sometimes we chartered accountants can do some engagement. Sometimes some clients will come to us and ask us to perform some engagements where we are not required to express any opinion, where we are not required to express any conclusion. Just the client will ask us to perform some procedures. We do the procedures and report our findings. Factual findings only we will report. So those kind of engagements we generally call them as agreed upon procedures, or even sometimes we will do compilation engagement. Like say for example, I'm a chartered accountant. One day a client has come to me and he told, sir, we used to have CFO previously who is a chartered accountant. That person used to look after the financial statements, but that CFO has left the company. And there is no one in our company who knows accounting standards and schedule 3. We have maintained books of accounts. You please help us in preparing the financial statements. We have all our books of accounts. You please help us to prepare the financial statements of company as per the Companies Act and Schedule 3 and accounting standards. Will I say yes or no? I can say it if the client is ready to pay the fees which I have agreed for. I will definitely accept that engagement. So here I am using my expertise to help the client to prepare their financial statements. This engagement, I call it as compilation engagement. So I am compiling the financial statements for the client. But you tell me, is this an assurance engagement? Am I giving any assurance? Am I giving any opinion? Am I giving any conclusion there? No. I am just using my expertise to help the client to prepare their financial statements. So this is one example of related service. Where I don't give any assurance. I will just agree to compile their financial statements. I will give you one more example. Say for example, one day a client has come to me. X Limited, a client is there. I'm a chartered accountant in practice. I'm sitting in my office. One day this client has came to my office and told, sir, we want you to perform some procedures only in the area of not audit. We want you to perform some procedures only in the area of trade receivables. We will tell you what procedures you have to perform. You are not required to choose also. What you are required to do, what procedures you have to perform also, that also I only will say. Like the client is saying that, sir, we want you to perform some procedures. What are that procedures is? Trade receivables are there. We will give you a list of all the trade receivables. You have to communicate with the external, you have to get the external confirmation. You please call the customers and give the external, you get the confirmation. Then what you do is, after you get the external confirmation, prepare one Excel sheet. In that Excel sheet, you mention the name of the debtor, and against each debtor, what is the amount as per books of accounts and what is the response you got from the external confirmation. Prepare one Excel sheet and give it to us. And also you do something called aging analysis. Out of this receivables also, you tell us, you prepare one format where you are telling which debtors are overdue for more than 30 days, more than 60 days, more than 90 days, more than 180 days. You do the aging report to us. And after doing all this, whatever your factual findings are there, no opinion, nothing. Whatever you found out, all that results, you put it in an Excel sheet and give it to us. So I said yes. The client is offering some very good amount of fees for doing that engagement. I said yes. So this engagement, I call it as agreed upon procedure. This engagement, I call it as what? Agreed upon procedure, And even if you pay close attention here also I'm not giving any conclusion, any opinion, nothing. I am giving no assurance. I am giving just the client has asked me to perform some procedures. I performed that procedures as it is. I have some factual findings. I have some factual observations. Whatever my findings or observations are there, that I will report it to the concerned person, whoever has appointed me. Now they will decide what opinion they have to do, what decision they have to take. Let them do whatever they wanted to do. So this we call it as agreed upon procedures. So I told you about two kinds of related services. One is compilation engagement, where I use my expertise to prepare the financial statements, to help the client to prepare their financial statements. And I told you about agreed upon procedures, where the client will ask me to perform some procedures. I will perform the procedures as it is, and whatever my findings are there, those findings I will report it. Factual findings only I will report it. So how to do these two engagements? To provide guidance for that, we have a series of standards called SRS. We have one standard which is providing us the guidance how to do the compilation engagement, and there is one more standard which is giving us guidance how to perform the agreed upon procedures. So that two standards are only we are required to discuss. So if you see here, SRS 4400, it is a standard which is providing guidance to perform agreed upon procedures. I told you, right? What is agreed upon procedure? Just remember this. Just keep this at the back of your mind. Trade receivables are there. Some procedures the client has told you. Those procedures you have to perform as it is. So that procedures you have to perform. Then after that, yeah. So SRS 4400, which is talking about engagement to perform agreed upon procedures. Similarly, if some client is approaching you and asking you to do compilation engagement, have I told you about compilation engagement also? Yes. So when a client is coming to you, asking you to use your expertise to help them to prepare the financial statements, how to do that engagements, that SRS 4410 is going to talk about. So if we could complete the discussion of these two standards, SRS 4400 and SRS 4410, this chapter related services will come to an end. And if your time is so good enough, very easy chapter, very small chapter. If a question comes from here, it is very easy to score the marks from this chapter. Why? Because hardly some 5 to 6 pages. If I'm not wrong, okay, some 7 pages of discussion is there. That too simple discussion we will have. No complications at all. And actually you are lucky if you get a question from this chapter. Okay, right. So let us see. First we will address SRS 4400. So if a client is approaching you, asking you to do some agreed upon procedures, what you are supposed to do, how you are supposed to do engagement. So now they have told objective. Why generally client will come to you? What is the objective of agreed upon procedures? In the case of agreed upon procedures, we carry out the procedure similar to audit. Like if you look at here the client has asked us to get the external confirmation, find out the differences, do the aging analysis. Here we are doing procedures similar to audit. But what is the difference here is we give report of factual findings only. We don't express any kind of conclusion. We don't express any kind of conclusion. We just report our factual findings. So an auditor simply provides a report on factual findings. No assurance is provided. We are not going to give any kind of assurance. Just whatever our findings are there, we will report it. And whoever users are there, they will use that findings to form their own findings, to form their own decisions. Okay. Once again, the differences they say, what is the difference between audit versus agreed upon procedures? The main point of difference is assurance. Where there will be assurance, in the audit there will be assurance. In agreed upon procedures, there will be no assurance, nothing. In audit we express opinion, in agreed upon procedures we report our factual findings only, we will try to report it. Next. So in case if the client has come to you and asked you to perform some agreed upon procedures, as per this SRS 4400, what are the things you have to do? How you have to do such engagements, what steps you have to take care, what precautions you have to take, what things you have to be careful. So now the complete guidance they are giving. So even if the client is coming to you and asking you to perform agreed upon procedures, am I required to comply with my ethical requirements? Yes. Why? Because SQC 1 says that in every engagement, be it audit, review, related service, any engagement you are doing, you are required to comply with the ethical requirements. So what are that ethical requirements? So like in every other engagement, even if you are appointed by the client to perform agreed upon procedures, there also you have to comply with 5 ethical requirements: integrity, objectivity, professional competence and due care, confidentiality, professional conduct and technical standards. 5 ethical requirements you have to comply. Sir, is the practitioner required to be independent also? Is the practitioner required to be independent also? Here independence is not required unless the terms of the engagement specifically mentions it. by default, there is no requirement of independence here. Why? Because we need the auditor to be independent, or we need the practitioner to be independent when he is expressing an assurance. But in the case of agreed upon procedures, we are not giving any assurance, right? Just we are reporting on factual findings. So here engagement assurance, here assurance will not be here, since we are not giving assurance, independence will not be required. Independence is not a requirement here. So independence is not required unless it is required as per the terms engagement. Unless client is so specific, there is no requirement for independence. Next, defining the terms of the engagement. Like in any other, like in audit engagement, we define the terms of engagement generally by way of what? Engagement letter. Do you think in the case of agreed upon procedures also engagement letter is required? More required than when compared with the audit. It is more required. The terms of the engagement is very, very important in the case of agreed upon procedures. Why? Because in audit, we have standards, we have laws which will tell us what procedures we have to perform. But in the case of agreed upon procedures, the name itself says whatever procedures we have agreed with the client, that only we will perform. If you don't have that agreed upon procedures in the written format, there is going to be a huge scope for misunderstanding. So that's why than in audit, in the case of agreed upon procedures, the requirement of documenting the terms of engagement is very, very high. So that's what they say here. The auditor should ensure with the representatives of the client a clear understanding regarding agreed upon procedures. Basically, engagement letter you have to draft. So what and all terms you have to agree, what and all things have to be included in the documentation. So what is the nature of the engagement? You have to clearly mention that you are not giving any assurance. In the terms of the engagement, in the engagement letter itself, you have to mention it. And you have to include what is the purpose, why this engagement is getting performed. You have to include the purpose. And you have to identify on which information you have to perform agreed upon procedures. Like in the case of example I have given, trade receivables is the information on which I have to perform agreed upon procedures. So you have to specifically mention on which information you are performing agreed upon procedures. And nature, timing and extent of the specific procedures. What exact procedures you have to perform, that you have to include it in the engagement letter itself. And also limitation on distribution of the report. If this report, for whose purpose this report is this report everybody, or it will go to only restricted persons? That also we have to include it in the engagement letter. So it is in interest of both the client and the auditor that the auditor sends an engagement letter and the client will sign it and agree to the terms of the engagement. Next, even what else you can go and include in the engagement letter is a list of all the procedures which you have agreed, and also distribution of the report of factual findings. As I have told, this engagement is not for everybody. Agreed upon procedures will be done only for the requirements of a specific user. So you have to clearly mention in your engagement letter that this report is not for everybody. This report is only for intended users. Next, what procedures you will perform? The procedures similar to audit only we will perform, like inquiry, analysis, recomputation, comparison, and other clerical accuracy checks like arithmetical accuracy, and doing the comparison like analytical procedures. Observation we will do, inspection we will do, or confirmation we will obtain. So like whatever procedures we do in the audit, similar procedures we are going to do even in the agreed upon procedures also. And then finally reporting we will do, and as I have told, reporting one point we have to be very clear. In the final report whatever we give, we will not express our, in the final report whatever we give, in that report we will not give any kind of opinion or we will not give any kind of assurance. Simply we will report on factual findings. Simply we will report on factual findings, but that report also should have one structure, so that report also should have one format. So what is the format for reporting is, there should be proper title, there should be addressee. You have to identify on which financial or non-financial information you have performed agreed upon procedures. That information you have to identify, and you have to mention a statement that you have performed only those procedures which you have agreed with the client. There is no freedom for you to choose the audit procedure. Only whatever you have agreed with the client, that procedures only you have performed. And you have to state that you have performed this engagement as per this SRS. Which SRS? SRS 4400. And also you have to identify purpose for which this engagement is happening. You have to mention in the report. And listing of specific procedures, what exactly you have performed, mention that in your report. And your factual findings, whatever your findings are there, that findings you have to report. And you have to mention one statement that whatever procedures you have performed, that is neither an audit nor a review. Why? Because you are not giving any kind of assurance. And also a statement that auditor performed additional procedures that might have come to light that would have been reported. So if you have performed any additional procedures, generally we will not do it. If at all you have done it, you have to disclose that as well. And you have to also mention that this report is not for everybody. This report is only for the intended users. And also a statement that a report relates only to elements, accounts or items and non-financial information to the extent and it does not extend to entities' financial statements taken as a whole. You have to mention that your audit procedures are restricted to only one or two items, not for the entire financial statements. Then you have to you have to mention the date, put the signature, place of signature along with your signature. You have to complete your report. And like the way we maintain documentation for audit, even for this agreed upon procedures also, we have to maintain a perfect documentation. So this is how we need to perform agreed upon procedures as per SRS 4400. Similarly, if a client is coming to you and asking you to do some engagement for them, asking you to prepare the financial statements for them as per the applicable financial reporting framework, here also we don't give any assurance, but how you will do that engagement, what precautions you have to take, all that we are going to see here. Okay. So first of all, what do you mean by compilation engagement? So compilation engagement is an engagement in which a practitioner applies his, practitioner means a chartered accountant like you and me, we will apply our accounting and financial reporting expertise. So basically we are the experts in accounting and financial matters. No, that's what we are getting all through this education. So in the compilation engagement, what we do is a practitioner like you and me, a chartered accountant, will use his accounting and also financial expertise. For what purpose? So he uses his accounting and financial expertise to assist the management. For what purpose? To assist the management in the preparation and presentation of financial information of an entity, that too in accordance with the applicable financial reporting framework. And here also you will give a report. After completion of your compilation engagement, you will give a report, but once again, in that report, no findings, nothing. Just you will say that you have done the compilation engagement. What are your responsibilities? What are client's responsibilities? That only you will try to mention. And one more thing here one more important you have to remember, compilation engagement is not an assurance engagement. So say for example, you are a chartered accountant in practice. One day a client X Limited has come to you. They told that they will give the information regarding books of accounts, and from that books of accounts you have to prepare the financial statements. So you are doing a compilation engagement here. You are compiling the financial statements for the client. Is there any requirement on you to verify whether the data given to you is correct or not, whether they have given genuine data or not? Is there any obligation on you to check the genuineness of the data given to you? Not required. Why? Because you are not giving any assurance. No, you are not doing any audit. You are not doing any verification there. What the client has told, we will give you data, prepare the financial statements. So that's what you are doing. Client is giving the data, you are preparing the financial statements. You are not doing any kind of verification work. You are not even supposed to verify whether they are giving correct data, fake data, all that you are not supposed to verify. Next. Okay. So, and the management might approach you, the client might approach you to prepare the financial statements. That financial statements might be general purpose financial statements. That financial statements might be special purpose financial statements. Whatever their need is. See, client might have 100 requirements here. If he is coming to us and ready to pay the fees, we will be ready to do the work. So sometimes you might be required to prepare the financial statements as per the Companies Act Schedule 3. Sometimes you might be asked to prepare the financial statements as per some special purpose framework. Whatever it is, it could be any engagement. Next, objectives. So if client has come to you and asked you to do the compilation engagement, then what are your objectives? My first and foremost objective will be, I will apply my accounting expertise, I will apply my financial reporting expertise, and I will help the client and I will assist the client in the preparation of the financial statements. And then finally, I will give a report. Once again, that report will not contain any findings, just my responsibilities, my duties, all that will be there. And what is the scope of compilation engagement? This will vary depending on the circumstances. Generally, in every engagement, one thing which is very common is what? Client will give me data. I have to use my expertise to assist them to prepare the financial statements. In some cases, what clients will do is, clients will even come with a draft copy of the financial statements. That means they have major knowledge, but in some standards and all, they might be lacking. So sometimes what the clients will do is, they might bring the draft copy of the financial statements. Just you have to review it once, modify some, suggest some changes, and make the financial statements ready. So it all depends. But everywhere we are going to use our financial and accounting expertise to assist the client to prepare the financial statements. Next. Now, one more thing you have to be clear. If you are a chartered accountant, if the client has come to you asking you to do the compilation engagement. Now, we all know that in the compilation, while compiling the financial statements, there will be various areas where judgments are required. Like accounting estimates, how much provision has to be created, all the judgments will be required. If the client is coming to you asking you to do this, asking you to do the compilation engagement, it is whose responsibility to make all that judgments? It is whose responsibility to determine that estimates, assumptions, which assumption will be appropriate. It is whose responsibility to make judgments. As a practitioner, you should do it, or it is the responsibility of the management only? It is the responsibility of the management only. So even though you are only using your expertise to assist them, the ultimate responsibility for making judgments rests with whom? Management only. The ultimate responsibility for determining which accounting policy will be appropriate for them, it will be whose responsibility? Management only. Once the financial statements are compiled, who will be responsible for that information in the financial statements? Once again, the management. So management only will take ultimate responsibility for the information provided. Management only is having responsibility for making judgments. Management is only having responsibility for determining appropriateness of accounting policies. Only as a practitioner, you will give your expertise to help them. That's all. Even after the financial statements are compiled, management only will be responsible for that financial statements, not the practitioner. So that's what they have told here. What will be the management responsibility, that they are explaining it here, just like as I have explained. Now, talking about ethical requirements. See, like in the case of agreed upon procedures, we told that the practitioner should comply with ethical requirements. Do you think even in the compilation engagements also, is there a requirement to comply with ethical requirements? Yes. Here also you need to comply with the 5 ethical requirements: integrity, objectivity, confidentiality, all that things you have to comply. Is there any requirement of independence here? In the case of compilation engagement, is there a requirement? Should the practitioner must be independent? No, there is no such mandatory requirement. Why? Because once again, compilation engagement is not an assurance engagement. It is a non-assurance engagement. Independence is not a requirement unless required by the terms of the engagement. Unless the client insists, there is no requirement from the standards to remain independent. Now, here also you need to decide, like the way we do in the audit, before accepting and continuing client relationship, we will evaluate the factors. No. So here also the practitioner, here they have told certain things. If a client is coming to you and asking you to do the compilation engagement, you should not accept that engagement unless he has agreed the terms of the engagement with the management. Nothing but first you should have a mutual understanding. First you should draft here also the engagement letter, understand the terms and conditions between you and the client, then only you should accept the engagement. Like what terms you have to agree, basically what things must be included in that engagement letter, like intended use, what is the use for which you are getting the compilation engagement, and what is the applicable financial reporting framework according to which I have to prepare the financial statements, what is the objective and scope of your engagement, and what are the responsibilities of the practitioner, what are the responsibilities of the management. Like as I have told, management is only responsible for financial information, they are only responsible for internal control, they are only responsible for providing accurate records and information, they are only responsible for making the judgments. So include one paragraph where you will explain all the management responsibilities and even what will be the form and content of the report. All these terms you have to agree with the client, and the practitioner shall record all the terms of engagement even before performing the engagement. That's what we do, right? Engagement letter will be drafted after starting the audit or before starting the audit. Same like even in the compilation engagements also, before starting the engagement only draft the engagement letter and get it signed from the client. And in the case of recurring engagements, now once again I said 210 like that will come into picture. So generally in audit engagements we say that in the case of recurring audit, year after year you need not give engagement letter. If you give it in the first year, it will be enough unless some changes are taking place, like changes in the ownership, misunderstanding of the terms. So if any such exceptional circumstances happen, then only year after year we will give engagement letter, otherwise not required. Then finally, once you have accepted the engagement, you have to start performing the engagement. So while performing the engagement, what precautions you have to take or what steps you have to follow when you have started performing that compilation engagement. First one, you should obtain an understanding of what? You should understand what is the entity's business, what are their operations, what is their accounting system, what kind of accounting records they maintain, and what is their applicable financial reporting framework to which industry your client belongs. Why? Because if you don't get all this information, you can't assist them in proper preparation of the financial statements. Why? Because if you have to judge which accounting policy is correct, how much provisions they have to create, what disclosures they are required to give, if you want to do that, if you want to verify all that, you can get it done. You can give better assistance regarding compilation of financial statements only when you understand your client's business, their operations, their to which industry they belong, what are the requirements of the applicable financial reporting framework. Only when you understand it, then only you can perform the engagement. And also once you have obtained the understanding, then you have to start compiling the engagements. Now actual compilation process will start, and you have to discuss with the management regarding estimates. As I have told, management is only ultimately responsible regarding the estimates. So you have to go and tell them, sir, in these areas you have to make the decisions, you have to create the estimates, so make suitable assumptions and create an assumption. And also, yeah, if you see here, if the practitioner becomes aware during the course of the compilation engagement, if the practitioner becomes aware that the documents which are provided to him for the compilation are incomplete, inaccurate, or otherwise unsatisfactory, he shall bring it to the attention of the management and request additional information. See, if the management is giving incomplete information and asking you to prepare financial statements, can you do that? No. So the management is giving incomplete information. If they are not giving full information for compiling financial statements, go and ask them, sir, without full information, how can you expect me to prepare the financial statements? So get the required additional information. And whatever it is, finally, you will assist the client, compile the financial statements. Now read the compiled financial statements prior to the completion. So once you sign off the engagement, so you should get the copy of the compiled financial statements and read it once. Sometimes what will happen is, when you are reading the compilation engagement, when you are reading that compiled financial information, you might you might ask the management to make some changes. You gave the assistance, okay, you told, okay, this should be treated like this, this should be treated like this. Now management, according to that instructions, they prepared the compiled financial statements and gave it to you. Once I read that compiled financial statements, I came to know that this is not perfect, some amendments are required to be made. So in case, while reading the compiled information, if you find that information is not adequately referred, or information is required to be updated, or information is materially misstated or otherwise misleading, what you should do is, you should propose the management to make the changes. Tell them, this is not the suggestion what I have given, this is what my suggestions are, but you are not doing it, please make the changes in the compilation engagement. You have to say that. In case if the management declines, if the management makes the corrections, okay, but in case if the management declines or does not permit the practitioner to make the proposed amendments, then what the standard has suggested is withdraw from the engagement. In that case is what you should do, withdraw from the engagement. You are giving instruction, but they are not following. I am asking to make the changes, but they are not making the changes. Then you should withdraw from the engagement. But in some cases, withdrawal might not be possible. In case withdrawal is not possible, then you determine, is there any professional and legal responsibility on you, like getting the legal advice, communication with the regulatory authorities. So like that, if any professional responsibilities are there, fulfill it. So I will get the copy of the compiled financial statements. I will read it. On reading it, if I suggest any amendments, if the management does it well and good, if the management does not do it, I have to withdraw from the engagement. If a withdrawal is not permissible, determine the professional and legal responsibilities. Next, sometimes you will not be able to complete the engagement. You are asking the information, management is not giving. Management is giving incomplete records. So from that incomplete records, you have decided that it will not be possible for you to complete the engagement. Then what you should do? If practitioner has decided that he is unable to complete the engagement, then he shall withdraw. He should resign from that engagement. He should not continue. Next, and finally, after, in case if the compilation engagement are all over, before you wind up your work, what you should do is obtain acknowledgement from the management. Nothing but a kind of written representation you have to obtain from the management that they are taking the ultimate responsibility. So ultimate responsibility for the final version of the financial statements rests with whom? Management only. Why? Because they are only providing the information. They have only made the estimates. They have only determined appropriateness of accounting policies. Just I gave them my recommendations on the basis of accounting standards. That's all. So that's why even I have assisted them in the compilation of the financial information. The ultimate responsibility for final copy of the financial information is always going to remain with the management. Even ask the management to return to accept that in a written format. And then communication with management and those charged with governance. So as a part of your compilation engagement, if you have find any matters which are required to be communicated with management and those charged with governance, fulfill those communication requirements also. And finally, you will give a practitioner's report. But as I have told, in that report, no findings, no reporting, no opinion, no assurance, nothing. Just some formal things like you will mention one title, you will give the addressee, you will say that you have compiled the information depending on information provided by the management. You will explain responsibilities of the management. You will also identify according to which applicable financial reporting framework you performed the compilation engagement. You identify the financial information including title of each element, like what is included in the financial statements like balance sheet, P&L, statement of cash flow, statement of changes in equity. So you describe the title of each element of the financial statement. Then you describe all your responsibilities. Then you describe all your responsibilities, and also mention that you have done that compilation engagement as per SRS 4410, and you should explain that compilation, what is a compilation engagement in a detailed manner, and you should add a few explanations like a compilation engagement is not an assurance engagement, and as a practitioner you are not required to verify accuracy or completeness of information provided to you. So you should mention that you have only done the compilation engagement depending on information provided, and you had no obligation to verify whether that information is correct or not, and you did not verify it. Let the users be aware of it. And practitioner does not express an audit opinion or any review conclusion on that engagement, that also you clearly highlighted. And in case if the financial statements are prepared, in case you are providing compilation engagement for financial statements prepared as per special purpose framework, in that case in your report you have to include for what purpose this information is getting prepared, for whose purpose. Special purpose financial statements are for specific users, no? So for which specific users, for what purpose this engagement has been done, that you have to clearly explain. And then finally date of the practitioner's report, and you have to put the signature along with the place of signature. And even for compilation engagements also you have to maintain the quality. Why? Because once again SQC1 says any engagement you are doing, be it audit, be it review, be it related service, be it other than historical financial information, for every engagement you have to maintain the quality. So as per SQC1, even for compilation engagements also you have to maintain the quality control. And like in audit we maintain documentation, whatever related matters for there, whatever important matters, whatever steps you have done, what evidence you have gathered, what conclusions you have reached in that compilation engagement, all that things should form part of your documentation. Clear? This is what regarding SRS. Very easy chapter I will say. And also as I was saying, very frequently they might not ask, but many a times they will ask. If you are lucky enough, you will definitely find a question from this chapter. And in case if you are finding the question from this chapter, it's going to be a jackpot for you. Why? Because easily you can score the marks. So that's why I will say, that's why I put this chapter under second category, where you spend less time but you have a high chance of getting the marks. Next. Now next what we will do is SAs we will do. 3000 series we will do. Right. So chapter number 16 we will try to address now, and the title of the chapter, as you could see here, it is going to talk about prospective financial information and other assurance services. So as I was just now saying, even in for SRS introduction also, as I have specified, so sometimes we chartered accountants might be required by our clients to perform some engagements which are other than historical financial information. We might not be always required to verify only historical financial information. Sometimes the clients might approach us asking us to do some engagements relating to other than historical financial information. And as I was saying, other than historical financial information means it could be a future financial information, or even it could be a non-financial information. So whenever any client is coming to you to do some engagement and the subject matter of that engagement is other than historical financial information, how to do such engagements, that guidance has been given under SAE series. And under SAE series we have three standards to be covered. One is SAE 3400, talking about examination of the prospective financial information, which is future financial information. And SAE 3402, which is talking about engagements to report on controls at a service organization, and SAE 3420 engagements to report on compilation of pro forma financial information. So three kinds of engagements they speak up here. 3400 talking about prospective financial information. 3402 it talks about verification of internal controls at service organization. Then we have SAE 3420 which is talking about pro forma financial information. So all these three standards we will try to cover it. So first I will try to start my discussion with SAE 3402. So SAE 3402 talks about prospective financial information. Sir, what is prospective financial information? So prospective financial information means simply future financial information. Sometimes, being a chartered accountant in practice, clients might approach you asking you to do some engagements where the subject matter of that engagement is not the historical financial information, but it is a future financial information. But it is a what? Prospective financial information. Like especially these kind of engagements will come when your client wants a loan from the bank will ask them to get some certified projections from the auditor or certified forecast from the auditor. Then the client will come to you and he will bring the next 1 year how the next year P&L will look like. In some cases, client will bring 5 years of projection. Next 5 years, what will be your profits? What will be the assets position? He will prepare some statements and he will come to you as a chartered accountant and he will ask you, sir, please do certify this projections or please do certify this forecast. Now you have to sign it. Now you have to verify and sign it. Now how to do such engagements? That guidance is given under SAE 3420. See, but before we can talk about how can we do that engagements, first we need to understand what are the types of prospective financial information. See, we can broadly divide prospective financial information into two categories. One kind of prospective financial information is forecast, and another kind of prospective financial information is projection. There are two kinds of prospective financial information. One kind of prospective financial information which we call it as forecast, and other kind of prospective financial information which we call it as projection. See, forecast refers to such a kind of prospective financial information which is based on best estimates. Whereas projection refers to such a prospective financial information which is based on hypothetical assumptions, best estimate assumptions I will say. And here in the case of projection, these projections are something which are based on hypothetical assumptions. Now what is this best estimate assumption? What is this hypothetical assumption? See, best estimate assumptions are those assumptions which are more likely to happen. Best estimate assumptions are those assumptions which are more likely to happen. Which means what? Say for example, company has prepared the forecast for the next 1 year, and how they have prepared the next 1 year forecast is depending on last 4-5 years of data they have analyzed. So from the last 5 years, profits are growing at 10%, revenue is increasing at 20%. Now in the next year also they have taken the same trend, and also at the time of making the forecast they already have contracts. Whatever sale contracts they have, that they have considered, and whatever commitments they have, that they have considered, whatever expense commitments they have, they considered, whatever capex expenditure they are planning, that they have considered. So everything reasonably they have considered and prepared the forecast for next 1 year. See, this is a best estimate assumption. This is more likely to happen. Even though it is an assumption, it is more likely to happen. Why? Because there is a basis. They have done it on the basis of past, on the basis of the current data, on the basis of pending sales contracts, pending expense contracts. Considering all this information, they have prepared this data. So this we call it as a best estimate assumption. Okay. Whereas hypothetical assumptions are, they might happen, they might not happen. Like company is there, one company X Limited is there. They need funding from venture capital. Firm. So now what they have done is they are going for a pitch that they need funding from the venture capital. They have prepared the next 5 years forecast, 5 years projection, where they have told that if the venture capital firm will invest their money in the company, if they give them 100 crores of funding to the company, now these 100 crore rupees they will invest in one big plant and machinery, and they invest their money in the big plant and machinery, their revenue will be this much, their expenses could be this much, they will make this much amount of profit, and coming forward in the next 5 years this industry is looking very prosperous, very future oriented, and all that, depending on all that they have prepared one projection. This document we call it as projection. Here this we call it as hypothetical assumption. Here this we call it as what? Hypothetical assumption. Which means what? Whether this could happen or this may not happen, there is no guarantee. And more likely that this will not happen only. So those kind of assumptions we call them as hypothetical assumptions, whereas we have in some cases we have forecasts which are based on best estimate assumptions. Now the client might bring the prospective financial information. Either he might bring the forecast to you, or either he might bring the projection to you. Now what you are supposed to verify with regard to that hypothetical assumption, with regard to that forecast or with regard to the projection is, when it comes to forecast, we need to check whether those assumptions are reasonable. We need to check whether that assumptions are reasonable or not, whether they are acceptable or not, that we need to check. For what? For forecast. But when it comes to hypothetical assumptions, we can't even check their acceptability also. Just we need to check whether they are consistent with the purpose. For whatever purpose they are preparing the projection, for whatever purpose they are using the hypothetical assumption, for whatever purpose they are using it, are the assumptions whatever they are made, are they consistent with the purpose or not? We need to check. Are they consistent or not? That only we will check. Whereas when it comes to best estimate assumption, we check the reasonableness. Clear everyone? That is our objective. Now one more thing, one more doubt should come to your mind. Sir, we have read the professional ethics, no? We have read the professional ethics. There in the second schedule, we have seen one clause. Do you remember, guys? If you look at the schedules which we have discussed yesterday, so if you remember this clause, which one? So if you are a chartered accountant in practice, if you are letting your name to be used, if you are permitting your name, or your name of the firm to be used with relation to a prospective financial information, which is giving a view that you are watching for the accuracy. Do you remember that clause? Then you will be deemed to be guilty of professional misconduct. If you are doing some work on future information and you are letting your name or your firm's name to be used in connection with the forecast, and which is giving a belief that you are watching for the accuracy, then you will be deemed to be guilty of professional misconduct, no? Now you should get it out. Sir, here if I do such engagements, I will be deemed to be guilty of professional misconduct, no? But now you are saying I can associate myself with the prospective financial information. Sir, how come, sir? Here I will do the professional misconduct. No, guys. What the professional ethics prohibit is, you should not associate your name in such a manner that you are watching for accuracy. So long you don't watch for the accuracy, so long you are not giving the guarantee that this will happen in the future, so long you are clearly saying that I am not saying anything that this will turn into reality. Just I am giving my opinion whether the assumptions are acceptable, whether they have given proper disclosure. That's all. See, when I am conducting the engagement of this prospective financial information, and whenever I am giving my report, in that report, I will not say, okay, this future information will turn into reality. On that, I am not going to give the opinion. But what I will give the opinion is, my opinion will be about whatever assumptions they have made, whether they are reasonable, and whether they have given all the disclosures in the prospective financial information. On that, I am going to express the opinion. So if I state clearly what assumptions are made and whether they have made the disclosures or not, if I state clearly in my report, and even if I add a line that I am not watching for the accuracy, I have just checked the assumptions and I have just verified whether they have given all the disclosures or not. If you take that care, then you can do such prospective financial information. Why? Because you have to be very careful that your wording, your phrases, your opinion, your report is not giving a misconception that you are watching for accuracy. You have to be very careful about it. So long you don't watch for the accuracy, there is no problem. You can get yourself associated with prospective financial information. Understood? So this is what regarding the overall structure. Now let us go into the technicalities of the standard. Quickly we will try to cover the important content. So I have covered what is the meaning of prospective financial information. I have covered what is forecast, what is projection, all that we have covered. Now, scope of the standard. So what does the standard talk about? I have already told you the standard is going to talk whenever we are doing the prospective financial information, then this will come into picture. But here they say one important point from the scope. Entirely one point is important. This essay does not apply to examination of prospective financial information which is expressed in general or narrative terms. See, this standard will become applicable only when we are verifying prospective financial information in quantitative terms, in numbers. If the prospective financial information is in numbers, is in figures, if you are doing that engagement, then this essay will become applicable. Say for example, companies will have something called management discussion and analysis. In that management discussion and analysis, they give qualitative statements regarding the future of the company. We will become the largest company in the world. This is also a future, this is also a prospective financial information, but it is a general disclosure, narrative disclosure, not expressed in figures. So for these engagements, SAE will not become applicable. Next, sir, who is responsible for preparation and presentation of financial information, prospective financial information? Generally, management is responsible. So management will prepare and present the prospective financial information. And what are their additional responsibilities is they have to identify and give proper disclosures in the prospective financial information. So in that prospective financial information, they have to give proper disclosure, what assumptions they have made, whether those assumptions are best estimate assumptions or hypothetical assumptions, and for what purpose they have prepared the prospective financial information, who are the intended users. All these are disclosures. Who is required to give? Management itself is required to give. Where? In the prospective financial information. And also they are responsible for explaining the basis of forecast. On what basis they have done the forecast, they have to explain it in the same prospective financial information, and even underlying assumptions, what assumptions they have made, that also they have to explain. Then I have already covered this paragraph. Can a professional accountant be associated with prospective financial information? The answer is yes. So long as you don't vouch for the accuracy, you can get yourself associated with the prospective financial information. Next, now what are the duties of the member? So just in case if you have accepted the prospective financial information engagement, now what are your duties? What and all you are required to fulfill? So what are my responsibilities? I need to obtain sufficient and appropriate audit evidence. Regarding what? So as I have told, if the management is preparing the prospective financial information on best estimate assumption, I need to check whether they are reasonable or not. Not unreasonable means reasonable. And if it is a hypothetical assumption, I need to check whether they are consistent with the purpose of the information or not. Then I need to obtain audit evidence whether the prospective financial information is properly prepared and it is properly presented and all material assumptions are disclosed. So I will check whether it is properly presented, whether all the disclosures are given or not. I have to check it. And even I need to check whether the prospective financial information is prepared on a consistent basis with historical financial statements. Say for example, 24-25 is just over. The management prepared the forecast for 25-26. Now whatever accounting policies they have followed in the historical financial information, the same accounting policies also should be followed while preparing the prospective financial information. Whether they are consistent or not, that also I will try to obtain the evidence. Next, nature of assurance regarding prospective financial information. See here, we don't give assurance that this will turn into reality. That kind of assurance we are not giving. That means our assurance is not relating to vouching for accuracy of the forecast. We give assurance, but that assurance is not that this future will turn into reality, but our assurance is relating to whether assumptions are reasonable, whether disclosures are appropriate. That is what our assurance is related to. Next, acceptance of the engagement. Precautions to be taken before accepting the engagement. If the client is coming to you and asking you to do the engagement related to prospective financial information, before you say yes to that engagement, there are various matters which you are required to consider. So what are that matters? What are that matters which you are required to consider? What is the intended use? For what purpose this prospective financial information is getting prepared? And will it be for general distribution or limited distribution? That means, is this information for everybody or only for restricted people? And what is the nature of assumptions? What assumptions the client has made? Is it a best judgment estimate or hypothetical assumption? And elements to be included. What are the elements which are included in the prospective information and for what period they are preparing the financial information? So all these factors you have to consider before accepting that engagement. And further, and this point is important, the auditor should not accept, or if he has accepted, he should withdraw when auditor feels that the assumptions are clearly unrealistic, complete bullshit assumptions they are using. If you know it well in advance, don't accept it. After acceptance, if you got to know about it, withdraw from the engagement. And also, if you believe that prospective financial information will be inappropriate for its intended use, that means they are going to misuse this prospective financial information after my report, then also withdraw from the engagement. Next. And also, you have to decide to what extent they can rely on the historical financial information. Like say for example, company is continuously in losses from the last 2-3 years. Just in the immediately preceding year, one exceptional circumstance happened. Because of that, there was a huge spike in the profits. Now you tell me, if they prepare on this one exceptional year prospective financial information, will it be appropriate? No. Why? Because it is an exceptional item. So you should not base your prospective financial information on this. Why? Because it is a extraordinary year. So you have to see whether in case of prospective financial information, how much they can rely on the recent financial statements. Next, examination procedure. So what procedures and all you will try to perform, the list of procedures they have given here. And according to what? You have to determine your nature, timing and extent of audit procedures by performing the below, by considering below matters. That means what procedures you will perform, how much time you will spend, will you do inquiry, inspection, what you will do. So nature, timing and extent of examination procedures will depend on the following matters. What are they? It depends on what knowledge you have obtained from the previous engagement. You have to keep into consideration whether management is capable. Do the management have enough of competence to prepare that prospective financial information? And what is the likelihood of the misstatement? If the risk is high, more procedures. Extent to which it is affected by management judgment, more the judgment, more will be the risk. And sources from which management has gathered the information, whether that sources are reliable. And stability of the entity's business. In case of stable business, okay, to some extent fine, prospective financial information will be less risky. In case of unstable businesses, like companies continuously facing losses, there a little bit more risk will be there. And engagement team's experience with the business and industry, your past experience also you have to consider. So all these factors you have to consider, and accordingly you have to determine nature, timing and extent of the examination procedure. Next, in performing these procedures, source and reliability of evidence also should be assessed. From which source you are getting the evidence and what is the reliability. And you can from various sources you can get the evidence like budgets, debt agreements, industry publications, etc. And in case if hypothetical assumptions are used, all implications should have been considered. Like for example, company is saying if we get the funding, we will make sales, our sales will increase by 100%. They have increased the sales, but for increasing the sales, you should have spent more money on the plant and machinery. That means your fixed assets and depreciation also should have gone up. So that implication is also considered or not, you need to check. So when you make assumption, all its associated things should be reflected in the assumption, not just you are doing only assumptions in your favorable areas. So all that things also you need to check it. Now finally, presentation and disclosure. So you need to check whether that prospective financial information is presented properly or not. So specifically what you need to check is the prospective information is informative and it should not be misleading, and accounting policies whatever have been followed in the prospective information, that should be clearly disclosed. What assumptions they have followed, that has to be clearly explained. Like I told, whether the assumptions are best estimates or whether the assumptions are hypothetical, that has to be clearly mentioned. And on which date this prospective financial information was prepared, that management has to give the disclosure. And basis for establishing a range. Sometimes what companies will do is they prepare prospective financial information not in exact numbers, in range they will prepare the prospective financial information, which means, say for example, they will say they will prepare prospective financial information something like this. Next 1 year revenue could be somewhere around 250 crores to 300 crores, and expenses, salaries could be somewhere around 100 to 125 crores. So like this, what they are saying, what they are doing is prospective financial information they are preparing, but not as a specific figure, but in the range. You need to check in those cases whether those ranges are reasonable or not. Next, if there is any change in accounting policy from the recent historical financial information, why they have changed it. As I have told, whatever accounting policies which are reflected in the recent financial statement, the same accounting policy should be followed even in the preparation of prospective financial information. If there is any change, I need to understand why that change has taken place. And then finally, after you have completed all your engagement procedures, now you need to give your report. What should be the content of the report? Let us see. There should be title, there should be addressee. You have to identify the prospective financial information. You have to give reference to the essays if applicable, and you have to mention that management is responsible for prospective financial information. And even you have to say that this report is restricted only for limited number of people, and you have to explain what examination procedures you have performed. Then this is very important, you have to give a negative assurance. You have to give a what? Negative assurance. Sir, what is this negative assurance? See, in audit engagements, we give positive assurance. Like if I have to give you one example to make you understand, in audit, if you are satisfied that financial statements are free from material misstatements and financial statements are prepared as per applicable financial reporting framework. In audit, if you have to give unmodified opinion, then how you will phrase your opinion? How we will phrase our opinion is, in case of unmodified opinion, we will say that according to the information and explanation given to us, to the best of our information and knowledge, the financial statements give a true and fair view. The financial statements give a true and fair view. We say our assurance in a positive way. But even in the review engagements also, review engagements we did not discuss, but we have SREs. In the review engagements also, say for example, if you have done the review and if you are satisfied, everything is okay. You want to say that everything is okay. But how you will say is, you will say that nothing has come to our attention which makes us believe that financial statements are misleading. You are saying in a positive thing only. You are saying a positive thing only, but you are phrasing it in a negative way. In audit, what we say? In audit, we say that financial statements are giving true and fair view. We are satisfied that financial statements give true and fair view. But in review engagements, the same thing they say it in a negative way. They say that nothing has come to our attention which makes us believe that financial statements are misleading. Positive thing only they are saying, but they are putting it in a negative phrase. The same negative assurance we have to give even in SAE, we have to give it in the case of prospective financial information. So how we have to use the phrase is, if we are satisfied that everything is okay, how you have to use the phrase is, yeah, this phrase you have to use. State whether based on examination of evidence supporting assumption, anything has come to the attention which causes belief that assumptions do not provide reasonable basis. Which means that if I am satisfied, assumptions are all okay, disclosures are all okay, I want to give an unmodified opinion. But I will not say directly, I have obtained sufficient and appropriate evidence and I believe that assumptions are reasonable. You should not say it like that. You have to put it in a negative phrase. So how you have to put it in a negative phrase is, you have to say that nothing has come to my attention which makes me believe that assumptions are unreasonable. So ultimately you are saying assumptions are reasonable only, but you are putting that phrase in a negative way. Clear? Able to understand everyone? So that's what they try to say it here. So you have to give a opinion, but a negative assurance you have to give. And also you have to express your opinion whether prospective financial information is properly presented on the basis of assumption and whether all disclosures have been given or not. And appropriate caveats concerning achievability. Basically, whatever assumptions they have made, whether they are achievable or not, on that also you can give a comment. Achievable in the sense realistic or not, that's it. Date of the report you have to mention, place of the signature you have to mention, and then finally you have to sign it. Now, what about modifications to the opinion? In the modifications to the opinion, I will try to explain it. Right. So these points I will try to summarize it, what they are trying to say here. Sir, when we have to give the modified opinion, say for example, you have verified the prospective financial information. Very important point, guys. Here most of the students will often get confused. They have a chance of getting tested in the MCQs also. So say for example, you have verified prospective financial information. See, there could be two options. Number one, assumptions are reasonable. Assumptions are reasonable. Whatever assumptions management have made, either if they are best estimate assumptions, they are reasonable. If they are hypothetical assumptions, they are consistent. Or there could be other case where assumptions are unreasonable. There could be a case where assumptions are unreasonable. See, if the assumptions are unreasonable, if you have verified prospective financial information and if you came to know that assumptions are completely wrong, assumption itself is wrong, then what the standard says is directly give an adverse opinion. Directly give an adverse opinion. But there could be a case where assumptions are reasonable. Management has made correct assumptions only, but they have given inappropriate disclosures. They did not present the information properly. Assumptions are okay, but they have made inappropriate presentation. That means they did not present that information properly, or they did not give the disclosures properly. So inappropriate presentation or disclosures. Assumptions are all okay. They made proper assumptions only. But the problem is with regard to the presentation. They did not present the prospective financial information properly. They did not give the disclosures properly. If that is the case, the standard says either give a qualified opinion or adverse. Here they have given the freedom. Depending on materiality and pervasiveness, you choose either qualified or adverse. But if you came to know that assumption itself is unreasonable, directly you have to give an adverse opinion. Here they should not show any concern, directly give adverse. But if assumptions are reasonable, but they have given inappropriate presentation, they did not give proper disclosures, then you have to give a qualified or adverse. There the freedom has been given to you. Next, in some cases what will happen is sometimes you will not be able to perform the audit procedures. Sometimes you will not be able to obtain evidence. In that case, what we should do? There the standard has told either withdraw from the engagement or give a disclaimer of opinion. So like if you read it here, when the examination is affected by conditions that preclude application of one or more procedures considered necessary in the circumstances, the auditor shall either withdraw from the engagement or he shall give a disclaimer. If you are unable to perform the procedures only, first possibility should be to withdraw. If withdrawal is not possible, then you have to disclaim your opinion. Then finally, documentation. You have to include various things in your documentation. Okay, then we have SAE 3402. This I will try to summarize it. This entire standard will not read it from here. I will try to summarize the entire discussion in the form of one quick overview I will give, and I will try to explain it. Okay. SAE 3402, I will try to explain in a quick manner. So just please pay attention. Right. What is the time? Okay, we are done with 3 hours 20 minutes of stream. Fine. So SA 3402. This is an engagement. This is an engagement relating to assurance reports on controls at a service organization. So sometimes, as a chartered accountant in practice, you might be called upon to verify some information and give the report, and that information is not financial information at all. It is not all, ignore whether it is prospective, historical. First thing, it is not a financial information only. Sometimes, as a chartered accountant in practice, you might be called to verify the internal controls only and to give the report only on internal controls. So what are that engagements is? For that, in order to know what is the specific engagement, we need to understand a few terms. So there are few terms like user entity. Then we have something called user auditor. See, this discussion, whatever I am saying, in this we will cover SA 402 also. Everything will get covered. Then we have something called service organization. Then we have something called service auditor. Then we have something called service auditor. Now, what is this user entity? What is this service organization? What is this? Who is this user auditor? Who is this service auditor? Let us try to understand it. Now, let us say, for example, there is a Reliance Industries Limited. Okay. Now, as we all are aware, in the today's environment, companies are outsourcing their activities, their HR operations, their payment operations, their trade receivable operations. All these they are outsourcing. So, what Reliance they have done is payroll activity, whatever their payroll activity is there, that they have outsourced. To whom they have outsourced? They have outsourced it to, say, for example, one Infosys company, not Infosys company. Okay, Infosys BPM is there. In the Infosys company, they have one wing BPM, BPO company is there. So where they will take care of outsourcing services. Okay. So now this company, Reliance Industries Limited, their regular payroll operations, what they have done is they have outsourced this activity to Infosys. That means what actually is the meaning of outsourcing is every month this Reliance Industries Limited, they will send their employee attendance records and all to Infosys BPM. Now what this Infosys BPM will do is they will calculate the salary, they will deduct the PF, ESI, and they will transfer the payments to the employees of Reliance. So here Infosys we call it as service organization. Why? Because they are providing outsourced services to Reliance. So here Infosys will become service organization. Okay. So Reliance is using the services of Infosys, right? So now here Reliance will become user auditor. User entity. Reliance will become user entity. So Reliance is a user entity, Infosys BPM is a service organization. Now what happened is this Reliance have appointed auditors. Say for example, KPMG, they have appointed them as auditors. So these are the KPMG is an auditor conducting audit of the user entity. So here KPMG we call them as user auditor. Now as we all are aware, payroll activities also will form part of financial statements, employee benefit expenses. These are also forming part of financial statements or not. Now KPMG auditors told that, sir, payroll activities you are not doing. Payroll activities you have outsourced it to Infosys. Now, if the Infosys BPM did not do the payroll processing properly, if they don't have proper internal controls for payroll processing, that will definitely have an impact on your financial statements. You are giving Infosys audit, Reliance auditors are telling to the company, sir, when it comes to payroll, you have to deduct a proper PF, ESI, gratuity, all these provisions you have to deduct and create proper provisions. If you don't do that provisions, what will happen is if you don't have proper internal controls in this area, that will cause a material misstatement in the financial statements. But what Reliance has done, you have outsourced it, no. So whatever internal controls Reliance is supposed to implement, now that Infosys BPM has to implement to make sure that they are doing the payroll processing in a correct manner, that salary is calculated correctly, PF is deducted correctly, TDS has been deducted correctly, and these are all deposited with the regulatory authorities. So like that, Infosys BPM should have strong internal controls, then only payroll processing will happen correctly. Now KPMG, this auditor wants to obtain evidence whether internal controls, whether Infosys BPM is having proper internal controls regarding the payroll outsourcing activities. Whatever activities that has been outsourced by Reliance to the Infosys BPM, in that area, Infosys is having proper internal controls or not, that KPMG wants to obtain audit evidence. that KPMG wants to obtain audit evidence, but they are auditors of Reliance, no, not auditors of Infosys BPM, right? And if you pay close attention, Infosys BPM will not provide this kind of payroll outsourcing to only Reliance. It will provide outsourcing services to multiple companies. Like it might be providing outsourcing services to Tata Motors, it might be providing outsourcing services to MRF, it might be providing outsourcing services to some 100+ companies. Now, if auditors of every company will come and say, hey, we want to verify the internal controls, we want to go to Infosys BPM and verify their internal controls, then Infosys regular operations will be a problem. Why? Because auditors or user auditors of all the user entities are coming and saying we will verify the internal controls at your organization. It will be a difficult issue for Infosys BPM or not. So in order to tackle that, what Infosys has done is they went to a chartered accountant in practice and they told, boss, we want one favor from you. Not favor, we want one engagement from you. What is that engagement is? For our user entities with related to that outsourced activities, whatever outsourced activities we are doing, in relation to that activities, we already have internal controls in our organization. But user auditors want to have evidence whether we are having strong internal controls or not. But we can't encourage all user auditors to come to our premises and verify the internal controls. That will be an obstacle for our regular operations. So what they are doing is, say for example, they went to Deloitte. They went to the one of the big four entity, Deloitte, and they told, boss, we want an engagement. What you are supposed to do is you verify this internal controls. Whatever internal controls that we are implementing for the activities which are outsourced by our user entities, on that internal controls you have to verify and you have to give a report on that internal controls. You have to give a report on internal controls. So if you could give a report on internal controls, that report we will send it to our user auditors. Like here KPMG wants whether internal controls at BPM is working effectively or no. If Deloitte does the verification of internal controls and if they give the report on internal controls, if any user auditor is asking, this Infosys BPM will forward that report to them. Similarly, if tomorrow MRF auditor is asking, hey, we want to know whether you are having proper internal controls for our client or not, Infosys BPM will send that report to them. Similarly, if tomorrow Tata Motors is coming and asking Infosys BPM, we want to get a cert, we want to know whether controls at your organization is working effectively or not, Infosys BPM will send that report which is given by Deloitte. So here this Deloitte will be called as service auditor. This Deloitte will be called as what? Service auditor, who is verifying internal controls at the service organization which are relevant to the user entity's financial reporting process. Here Deloitte is conducting is doing the verification of internal controls which are operating at the service organization which are having an impact on financial reporting of user entity. So now this engagement, here Deloitte will be called as service auditor. Here Deloitte has been called upon to verify the internal controls and give a report on that internal controls. How that Deloitte should do the engagement, that guidance has been given under SAE 3402. Able to understand? So how this Deloitte is supposed to complete this engagement, how they are supposed to perform that engagement, that guidance has been given under SAE 3402. So let us try to understand what does SAE 3402 say. I will give you a brief, guys. So this standard will contain a lot of information, a lot of information they will say. If I go into line by line reading, so it will not be enough. Even 1 hour I can teach this standard in our regular class and EOB classes. We have discussed this standard in a very comprehensive manner. Students actually love the standard because of the way we teach it. So such an interesting standard it is, but here I can't afford to go line by line. Just I will give you a brief of the standard. So what does SAE 3402 say? So SAE 3402 says that service auditor can give two types of report. There are two types of report which a service auditor can give. One is, we call it as type 1 report and the other one is type 2 report. So what is a type 1 report? What is a type 2 report? Listen carefully. What will be included here? See, in both the cases, what will happen is, first, management of the service organization, they will give a description. They will give a description of internal control system. They will describe how the internal control system has been, how the internal control system is operating. They will give a description. Basically, they will prepare one document. In that document, they will explain what is their internal control system, what kind of controls they have implemented, so how they have designed it according to some applicable criteria. There will be some applicable criteria. According to that applicable criteria, they will prepare the statement. Okay. So after they have made the statement, now they will make some assertions. They will make some written statements. Management will make some written statements. What written statements they will say? They will say that whatever description they have given, whatever description of internal control system they have given, that they have given genuine description only. If I look at the terminology here, just I want to make you understand the terminology. Right. If you see here, So first, the service organization will give a description. Then what they will do is a written confirmation they will give. What written confirmation they will give? Whatever description they have given that represents fairly service organization system as designed and implemented. That means the management of the service organization. In our example, Infosys BPM will prepare a description of explaining their internal control system. Then along with that, they will also make some written confirmations that whatever description they have given, that is a fair presentation. That means whatever is actually designed and implemented, that is only given. And along with that, they will also say that the controls related to the control objectives were suitably designed. They will also make one written confirmation that whatever we have described, that we have designed, we have done the proper designing of the controls as at a specified date. Pay attention to the terminology, guys. So what will happen in the type 1 report? The management of the service organization, they will give a detailed description of internal control system as in operation. And after that, they will give some written statement. What written statement they will give? They will say that whatever description they have given, that is a fair presentation. Whatever is really happening, that only they have described. And also they will say that they have properly designed the controls as at specified date. Say for example, as at 31st of March 2025. So our description is fair presentation, and as on 31st of March 2025, we have designed all the controls. Now what the service auditor will do is, now the service auditor will express the opinion whether really description is a fair presentation, and also he will express the opinion, he will also comment whether the controls are suitably designed or not. The management is telling description is fairly presented, no, and also they are telling the controls are designed properly, no. So whether really the description is a fair presentation as at specified date, and whether they are saying that they have properly designed the controls, whether they have really designed the controls properly or not, that service auditor will verify and give the report. That is a type 1 report. That is a type 1 report. If he is satisfied, he will give a modified opinion. He will give an unmodified opinion. If he is not satisfied, he will give a modified opinion. All that is okay. All that is common. But in the type 1 report, what and all will be there? Management will prepare a description of internal control system. Then they will make written confirmation that whatever description they have given, that is fair presentation, that is fairly they have presented it. And whatever controls they have described in the description, they have suitably designed it as at specified date. And that will be verified by the service auditor, and he will express the opinion on whatever confirmations management has made. So he will express the opinion whether really the description is fairly presenting the system, and they are saying that controls are suitably designed, whether they are really designed suitably or not, that he will give the comment. That is type 1 report. Now, when it comes to type 2 report, here also what will happen is management of service organization will give description. They will describe in a detailed manner what controls they have as per some applied criteria. After they have given the description, they will make written assertions. Regarding 3 things here, they will give assertion. Number 1, first assertion they will make that description is a fair presentation of system as designed and implemented. So whatever is really designed and implemented, that only they have described. Number 2, they will make an assertion that these are whatever controls which have been implemented, whatever controls which have been described, they are properly designed. They have designed it properly. And also they will make a written confirmation that those controls are even operating effectively. Even they will make a confirmation that the controls are operating effectively. This will be done for a specified period. Type 1 report will be as on specified date, but type 2 report will be for a specified period, for a specified duration, for the entire financial year, for this quarter. So like that, it will be for a specified duration. It will be for a specified period. Whereas type 1 report is as on specified date. And if you could have paid attention, what is the difference? In the type 1 report, the management is only making assertions regarding description is a fair presentation and they are suitably designed. They are not commenting on whether the controls are effective or not. But in the type 2 report, management will describe their system and they will make written confirmation that description is a fair presentation and they have designed the controls whatever have been presented in the description in a suitable manner, and they will also make a written representation that all these controls are working effectively. That also they will confirm. not as a specified date, for the specified period, for the entire period they are properly designed, they are properly implemented, and description is a fair presentation. And on all these three matters, service auditor will give the opinion. Service auditor will give the opinion about all the three. Which three? He will express the opinion whether really the management has given a fair description of the system, and whether those controls which are explained in the description are suitably designed, and whether those controls are operating effective, whether those controls are operating effectively or not. Able to understand? So like this, two types of reports. It all depends on the terms of engagement. Whether auditor will give type 1 report or he will give type 2 report, that all depends on the terms of the engagement. So sometimes the client, sometimes the service organization might appoint you only to give type 1 report. Sometimes service organization might appoint you to do type 2 report. They might also ask you to comment on the operating effectiveness also. So which kind of report auditor will give, that all depends on the terms of engagement. But whatever it is, as per SA 3402, two kinds of reports can be issued, type 1 report and type 2 report. Okay. So this much is enough. I don't want to go into further details. If I, once again, as I've told you, no, I can't afford here. I can't afford the time here to go and read each and every point. Apart from this, if you understand this differentiation between type 1 report and type 2 report, if you refer to the standard, you can easily understand the concept now. See, many students will not read this standard only, but I am telling you, if you understand the concept now, you will love the standard. You will love the standard. So I have experienced this feedback from the students. So when I ask some other students, they will say they did not read SAEs only. They did not read SAE. They did not read SRS, they will say. But just ask my students who have attended my classes how much they love these other standards, SRS and SAEs, because it all lies in understanding the concept. If you could get the perspective of the concept, no, you are going to love it. Right. Fine. See, one student is asking, see, what is the difference between SA 402 and SAE 3402? SA 402 and SAE 3402. This also I will explain. Good question. So what is the difference here is, SAE 3402 will talk about the responsibilities of the service auditor. No? Now, this user, why the service auditor will give the report? The service auditor will give the report so that the service entity, the service organization will forward that report to user auditor. So this type 1 or type 2 report will be given to the user auditor. Now the user auditor should make use of that type 1 or type 2 report for forming an opinion on the financial statements of Reliance, right? Now when a user auditor making use of the service auditor's report, what precautions this user auditor has to take, what things you need to verify, what precautions you have to take, what procedures he has to perform, that's what SA 402 says. Able to understand? So SA 402 is talking from the perspective of user auditor in relation to audit of the financial statements. So SA 402 is a standards on audit. So here user auditor, while conducting audit of Reliance Industries Limited, if it decides to make use of the service auditor's report, what precautions, what things you have to consider, that's what SA 402 will give the guidance, whereas SA 3402 will become applicable for the service auditor. I hope the difference was clear now. Good question, excellent, very good. Able to understand the student who has asked that question? So just reply back. Super, nice. Good. Okay. So we are done with the SAE 3402 also. Now let us try to proceed further and understand one more last standard from this SAE series. Just give me a minute. Just give me 1 minute. Yeah, sorry. Yeah. SAE 3420, this is the standard which is going to talk about how to conduct audit of the pro forma financial information. So here also first we have to become clear what is the meaning of the pro forma financial information. If we could understand the pro forma financial information, then understanding the standard becomes relatively easy, right? So what is pro forma financial information? Let me try to explain that in a brief manner, then we will proceed further. Right. So what is pro forma financial information? See, pro forma financial information is such an information which is generally included in terms of, which is generally included in the case of issue of shares and all. So in two major cases, they prepare pro forma financial information. One is at the time of issue, shares issue, and the other one is at the time of acquisition. At the time of acquisition, in the prospectus or in that merger document, they prepare this something called pro forma financial information. So now what is this pro forma financial information is? Say for example, the company is about to issue the shares on 30th of September 2026, 2025, the company is about to issue the shares. Now the management has taken that decision. The management, as on 1st of June 2025, the management has taken the decision that on 30th of April, they will make the issue of the shares. Some quantity of the shares they are going to issue. So now what the management will do is, when releasing the prospectus, what the management will do is, they will take the last year's balance sheet. They will take the last year's balance sheet. Say for example, last balance sheet is 31st of March of 2025. As on this date, balance sheet is prepared, P&L is prepared. Now they will take this information, and as on this date, as on 1st of June 2025, they will determine what if this issue of shares has taken place as on 31st of March only, how the financial statements will look like. They will redraft the financial statements. What they will do, they will take the financial statements as per the last audited balance sheet date or last balance sheet date, 31st of March 2025. They will take this balance sheet and P&L, and they will imagine the issue is going to take place as on 30th of March. No, what if this issue has been taken place as on 31st of March of 2025 only? How the financial statements will look like, how the balance sheet will look like, how the P&L will look like, what will be the impact on dividend and EPS and all, that they will prepare one information that we call it as pro forma financial information. That we call it as what? Pro forma financial information. So now if you see the entire process, how the pro forma information is created. So first they will take something called unadjusted financial information. What they will take? Unadjusted financial information. In our example, unadjusted financial information is financial statements as on 31st of March of 2025. Now to that unadjusted information, they will make something called some adjustments, which we call them as pro forma adjustments. They will make some adjustments, which we generally call them as what? Pro forma adjustments. So they will do some pro forma adjustments. Nothing but, as I have told, they will imagine what if the issue has taken place now only, as on the balance sheet date only, if the issue has taken place, how the financial statements will look like. They will make some pro forma adjustments. So by making that pro forma adjustments, they will get one resulting information. That resulting information, we call it as pro forma financial information. And this pro forma financial information, generally they will include it in the prospectus document and all. Now sometimes some clients might approach you asking you to do the verification or to conduct the audit of that pro forma financial information. However, this is also not a historical financial information, right? This is also some information which is relating to other than historical financial information. So if you are a chartered accountant and if some client is approaching you asking you to do the verification of the pro forma financial information and give your assurance on it, how to do that engagements, that is what covered under SAE 3420. That is what covered under SAE 3420. Most of the things are going to remain the same like whatever we have discussed in the previous standards. So let us try to quickly revise this standard also, in case if the client is coming to you and asking you to do the audit of or verification of that pro forma financial information, how you are supposed to do, what and all steps you have to take care, how you have to do the reporting and all. So reporting part is a little bit tricky here. Rest of all the things are going to remain common. So let us try to understand what they are trying to say here. So first of all, what is the meaning of the pro forma financial information? They say that pro forma financial information refers to financial information which is shown together with adjustments to illustrate impact of an event or transaction on unadjusted financial information as if the event has occurred or transaction has been undertaken at an earlier date selected for the purpose of illustration. So some transaction is about to take place in the future, but they will imagine as if the transaction has taken place at an earlier date, what could have been the impact, that they will do the adjustments to the unadjusted financial information, and from that you are going to get the resulting information. That resulting information we are going to call it as pro forma financial information. And where generally we use this pro forma information is in the offered documents, like in the prospectus in the case of issue of shares, or before acquisition, after acquisition, how the entity will look like. If the acquisition has taken place at an earlier date, how the information, how the financial data would have looked like. So especially in the case of that documents, offer documents or acquisition related documents, this information will be included. Now, if a client has asked you to do the engagement relating to pro forma financial information, what will be your objective? My objective will be to obtain reasonable assurance whether this pro forma financial information has been complied as per applicable criteria. Same like audit, guys. In the audit, what they say here is, as an auditor, you need to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting criteria. This is what they say, no? Generally in the audit engagement, what is our objective? As an auditor, we need to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework. Now what they say here is, just they will replace the phrases. They will say whether practitioner, in the case of this engagement, practitioner should obtain reasonable assurance whether pro forma financial information has been prepared as per applicable criteria. That's all. Everything will remain the same. Whatever we read in the audit, everything they will try to repeat it here. Just they will replace the terminology. In audit, they say auditor needs to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework. But here they will say the practitioner should obtain reasonable assurance whether pro forma financial information has been prepared as per applied criteria. That's it. That's the only difference here. Right. So compilation of pro forma financial information. Oh, okay. So this how they will compile. I have all this how they will compile. Who will compile the pro forma financial information? Management will compile the pro forma financial information. How they will compile it? First, they will identify the source. Basically, they will identify the source in the sense unadjusted financial information. So they will identify to which unadjusted financial information they are going to make the adjustments. So they will identify the source. To that source, they will make the pro forma adjustments, and finally, whatever pro forma financial information you get, that pro forma financial information they will present it. Next. So who will compile? Management will compile. Will the practitioner has a responsibility to compile the pro forma financial information? No, practitioner will not compile the pro forma financial information. Who will compile the pro forma financial information? The pro forma financial information will be compiled by the management only. Next, what else? What are the steps involved? So here also, first you need to determine whether you can accept such engagement or not. So here they say that generally you will accept that engagement only when you decide that whatever criteria which is used by the management in preparation of that pro forma financial information is acceptable. If the applied criteria is not acceptable, you should not comply, you should not perform that engagement. Same in the audit, they will say. In audit, generally what they say here is you should accept the engagement only when the applicable financial reporting framework is acceptable. Now on the same lines, they will say here, you should accept this engagement to perform pro forma financial information only when you find that this applicable criteria which is used in the preparation of that pro forma financial information, if it is acceptable, then only you accept it, otherwise you don't accept it. So who will establish that acceptable criteria? Generally, we will see whether there is any criteria for that as per the standards on audit, as per some accounting standards, as per some regulatory bodies. Is there any framework that we will decide? If there is no such established criteria, management itself will decide the applicable criteria. If the applicable criteria is decided by some regulating authority or standard setting body, that they will follow. If there is no such applicable criteria which is determined by regulatory authority or standard setting body, management itself is going to decide that applicable criteria. Next. Yeah. So here also, like in audit, before accepting the engagement, what and all you will consider, same they will say here. Here also will consider whether practitioner is competent and capable or not. Then on the basis of your preliminary understanding, you need to determine whether applicable criteria is suitable or not. Determine what kind of wording management is expecting from you, whether you can give that kind of wording, whether you can use that wording depending on the evidence or not. You need to determine it. And from which source you are getting the unadjusted information. Is it audited or unaudited? If unaudited, sometimes this applicable criteria will not permit you to use unaudited information. So you need to check it. So the source to which you are making adjustments, is it audited or is it unaudited? If it is unaudited, is there a permission from the applicable financial reporting framework? Sorry, is there a permission from the applicable criteria to use that unaudited information for pro forma financial information? You need to get that thing. Next, what else? If you came to know that if the adjusted information, if the unadjusted information has never been audited, then you need to perform some extra procedures to obtain understanding of that unadjusted information's accounting policies also. Then you need to obtain responsible parties agreement. Nothing but in audit we get the agreement regarding management responsibilities, that they are responsible for preparing the information, they are responsible for internal controls, they are required to provide access to all the information to the practitioner, they should provide additional information, they should also provide access to the people within the organization. Like the way we get the written confirmations in the audit, same written confirmation regarding management's responsibility, we should get it even in the case of this pro forma compilations also. And you have to plan and perform the engagement. Then finally you should plan your engagement, you have to perform your engagement. So how you will perform the engagement? Like you will determine once again whether applicable criteria is suitable, and you should also determine materiality, what is material, what is not material. Then you need to obtain understanding how responsible party has compiled with the information. Then you need to obtain evidence whether the source is appropriate or not, the source from which you are getting the information, is it appropriate or not, we need to check. And if the source is unaudited, or if there is no review report also, it is neither audited not reviewed, then we need to check whether it is suitable for me to use that source or not. Next, the practitioner shall determine whether responsibility has appropriately extracted, whether that information has been appropriately extracted or not, that we need to check. And even you need to obtain evidence regarding appropriateness of the pro forma adjustments. Next, what else? So all this is common, everything is same. So this is also written representations you will obtain, like the way we obtain written representations in the audit, we need to obtain written representations even in this case also. Then finally you will give the opinion. So if you are satisfied that pro forma financial information has been compiled in all respects by the responsible party on the basis of applicable criteria, basically like audit, if you are satisfied that financial statements are prepared as per applicable financial reporting framework, we give unmodified opinion. On same lines, if you find that pro forma financial information is prepared as per applicable criteria, then also you will give unmodified opinion. Then comes next, modified opinion. See, sometimes what will happen is, so here is where some little things they will try to say here. So this modified opinion we have to understand. After that everything is common. This all we have already covered in other essays. Only one point which we need to cover here is modified opinion. So here what they say here is, say for example, you have verified the pro forma financial information. You came to know that this pro forma financial information is not prepared as per applicable criteria, and you are not satisfied with it. Why? Because this pro forma financial information was not prepared as per applicable criteria, you did not prepare it. That means management has not fairly presented the pro forma financial information. Now generally what you are supposed to do, you are supposed to give a modified opinion, right? But sometimes this rules and regulations says that if the pro forma financial information contains modified opinion, that information should not be included in the prospectus. Sometimes regulatory authority will say, if the pro forma financial, any information which contains the modified opinion should not be included in the prospectus. Like that, law will put a restriction. In case if the law has put such a restriction and you felt that modified opinion is appropriate, first you should go and request the management, sir, I am supposed to give modified opinion. But even if I give the modified opinion also, you can't include that in the prospectus. So please do the corrections to your pro forma financial information. I will go and request to the management. In case if the management rectifies is well and good, then I will give unmodified opinion. But in case if the management is not changing, in case I have to give modified opinion, but the law or regulation is prohibiting to include the modified information in the prospectus, and the management is not ready to change. Now what I should do, sir? I can't give modified, no. Even if I give the modified opinion also, no use. That will not be included in the prospectus, right? So what I should do in that case? So if you read it here, where relevant law or regulation prohibits publication of a prospectus that contains a modified opinion with regard to whether pro forma financial information has been compiled in all material respects on the basis of applicable criteria. That means law or regulation is prohibiting you to include this modified pro forma financial information in the prospectus. In that case, but practitioner concludes that modified opinion is appropriate, then what you should do, go and discuss the matter with the responsible party. If the responsible party does not agree to make necessary changes, I went and requested the management, sir, I have to give modified opinion, but if I give modified opinion, you can't include it in your prospectus. Please make the changes, sir. But even after requesting also, they are not making the changes. Then what the standard says is, if possible, withdraw from the engagement. Withdraw, unnecessary, no, by continuing the engagement there. So withdraw from the engagement. If withdrawal is not permissible, then you go and get the legal advice. Go and get the legal advice. However, if there is no such restriction from the law did not put any restriction, even if the pro forma financial information contains modified opinion, that also can be included in the prospectus. When such a restriction is not there from the law or regulation, what you can do is you can continue the engagement and give the modified opinion. No need to withdraw. You can continue the engagement and modify the opinion. Understood? Clear and comfortable, everybody? Then they have told about emphasis of matter paragraph, like the way in the case of audit, if we find any information is already presented or disclosed, but which is fundamental to users' understanding of the financial statements, we highlight it in the emphasis of matter, right? The same thing, even you can do it in the prospective financial information also. And finally, you have to give the report. In your report, various contents should be there, like title should be there as a addressee, and you have to include an introductory paragraph, which is similar to the opinion paragraph. Then you have to explain a statement regarding what is the responsible party's responsibilities, and responsible party in the sense management will come here. And also you have to explain in a detailed manner what are your responsibilities, like your responsibility is to express an opinion, and you are not responsible for updating or issuing any reports on any historical financial information. And the purpose of pro forma financial information in the prospectus is to illustrate the impact. So what is the purpose of the pro forma financial information, that also you have to explain. And you have to mention that you have performed this engagement as per this particular standard CA 3420, and also a statement about what is a reasonable assurance engagement, and whatever applied criteria, whatever applicable criteria which has been used, is that acceptable or not. And also related pro forma adjustments give appropriate effects, whether pro forma adjustments have been given proper effect or not, and whether they are doing a proper application or not, reflects proper application of those adjustments in the unadjusted financial information. Basically, whether they have properly presented that pro forma financial information or not, that assurance you have to give. And also you should mention that these procedures are depending on practitioner's professional judgment, and you have to express your opinion and use one of the following phrases: pro forma information has been complied in all material respects on the basis of applicable criteria. Or even alternatively, you can use the phrase the pro forma financial information has been properly complied. So here we are giving positive assurance only. Like the way in audit we give positive assurance, here also you can give positive assurance. You can say whether pro forma financial information has been compiled as per the applicable applicable criteria or not. So you can give a positive assurance. Finally, you have to sign the document. You have to mention the date of the report, and even you have to mention the place of signature. And like the way we maintain documentation, here also we are supposed to maintain the documentation. Understood? So this is what regarding CA 3420. Very interesting standards actually. So in the regular and DOE batches, we spend a lot of time here. So very interesting standards. Practically, this is where the money is there in the industry. So this you have to learn it not just from the examination perspective. For your practical, for your practice also, this will help you out. So this is where a lot of money is there. Yeah. So whatever it is, we have covered SAE and SRE, and I have few more things to be covered in second priority chapters. As I have told, internal audit is there, group audit is there, SDG, ESG. This also I want to do the revision. Along with that, I have also promised to do the revision of audit of banks and audit of NBFCs. So that I will do, that I will upload it on the YouTube. We will not have live for this, but I will get it done, but I will get it recorded and upload it on the YouTube. Okay. So these 5 chapters, anyhow, I will do a separate revision. So live marathon from today, it will come to an end. Tomorrow we will discuss. Not tomorrow. So in the coming 1 or 2 days, I will upload the revision covering the remaining chapters as well. Okay. So that's all for now. See you in the next part. Bye.